It is 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman, and here are 3 things that you need to know this morning. Retail sales below past estimates at 0.7% growth on the month, with the core number shooting up to 1%. The reading gives the Fed more food for thought ahead of that September meeting. Staying with the consumer, Home Depot beats the street and reiterates its guidance, but that's not the big takeaway here. Sales declined 2% on the year as customers avoided big ticket purchases. Retail is in focus today, but it's not the only sector to watch. Banks will also be key as Fitch warns it may have to downgrade dozens, including JP Morgan. And China cuts a key lending rate, and the data tells you why. The PBOC, the People's Bank of China, lowers the interest rate on the 401 billion yuan worth one-year medium-term loans from 2.65% to 2.5%. Now, it comes as retail sales, industrial production, and fixed asset investment all missed expectations. The MLF is just one of China's key rates and serves as a guide to where the benchmark loan prime rate could head. Adding to the economic concerns, China suspended publication of rocketing youth jobless data. It says it needed to review the methodology behind it. And a grand jury in Georgia has indicted former President Donald Trump as part of a sprawling investigation into efforts to overturn the 2020 election. The 13 felony charges include racketeering and election meddling. The overall 41-count indictment names lawyers Rudy Giuliani and John Eastman among 18 co-defendants. It marks the 4th criminal case brought against the former president in as many months.
And retail sales came in hot for the month of July, up 0.7% compared to June. If you exclude autos and gas, sales were up 1%. This is the largest gain in 6 months, boosted by e-commerce, which was up 1.9%, likely thanks in part to Amazon Prime Day. Both of these numbers, by the way, blowing away estimates. And we also saw some upward revisions for the 2 prior months. In other words, consumers are spending. If you look at some of the other areas where they were spending, it wasn't just online. Food, services, and drinking places also saw gains of 1.4%. So we continue to see momentum in that area, and indeed, that actually accelerated in that area.
Yeah, and some of the key areas that we continued to kind of look through over the past month to see where there is some moderation here. And I look at the vehicle part of this particular report, too, because motor vehicle parts and dealers, that's still high. That's up right now, at least year-over-year change, 3.4%. But some of the other areas where you're actually seeing some of the larger decreases, and this is something to keep in mind even as we talk about some of the other retail earnings report that are set to come out this week. Year-over-year changes down. Furniture and home furnishing stores, that's down by about 3.8%. You saw the year-over-year change for electronics and appliance stores. That's still down by about 2.1%. All of these different categories where we've heard from Target, we've heard from Walmart, and some of the specialty retailers about where consumers are being more stringent about where their dollars are going, and that playing a role in some of the other earnings that came out even this morning in those big ticket purchases. So with regard to that, keep a close eye on that part of this broader retail sales equation at this point.
Yeah, I'm also looking here at some of the other numbers that month over month that saw increases. Clothing up 1.0%. Sporting goods, hobby, musical instrument, and bookstores, they throw a lot in that one, up 1.5%. So those were some other areas of strength. Electronics and appliances down. Furniture and home furnishings, you mentioned down year over year, also down month over month. And the same goes for autos. So there were some areas of weakness, but you know, the non-store retailers one really stands out to me, and the clothing one stands out to me as well, because that too is a re-acceleration. So, you know, it's interesting here, especially as we get into the retail earnings season, to see that strength in apparel specifically. You know, we've been talking to some analysts who cover the sector recently who have been a little bit more positive here. You know, we talked to Simeon Siegel last week in the wake of the Tapestry agreement to buy Capri, but he also said that we are now at, you know, we keep using that word normalization, but we are, he said, at a more normal level in terms of inventory for many of the apparel and specialty retailers that now will allow, you know, strong and weak management teams to come to the fore rather than the inventory winds of change that they were all subject to.
Yeah, and also keeping a close eye on how those management teams, especially across department stores, which within this report, you take a look at that department stores line, and month over month here particularly, that jumped out to me as well, because we did see a decline month over month by about 3.4% within the department stores specifically. Think about companies like Macy's. Think about companies like Nordstrom, and Nordstrom, of course, the subject of one of the more viral videos right now, having to deal with shrink. Many of these companies having to think about that in one facet or another. But for the department stores and where they are seeing some of that wavering in favorability, at least on the sales side or on the pricing side, that's going to be particularly interesting to see how they're managing through inventory that they may have as well, given the pushback in price that they're seeing among the consumers. So that jumped out to me just a moment ago here, even as I'm taking a look at Macy's shares, fractionally lower here pre-market. Nordstrom shares down by about 1.7% here pre-market too.
Yeah, and then there's another kind of retailer that we're talking about this morning too.
Yeah, they got lumber. Home Depot, they kicked off a big week of retail earnings this morning with another drop in same-store sales. The home improvement retailer saw sales fall 2% compared to a year ago, driven lower by a decrease in transaction growth and a lower average ticket growth. Now, the company also reaffirmed its guidance that it set last quarter, expecting a drop in sales and adjusted earnings for the full year as consumers remain cautious. Home Depot did beat analyst expectations for revenue for the first time in 3 quarters. That came in at $42.92 billion in Q2. And adjusted earnings per share, that came in at $4.46. So a slight beat there. And we had some of our key takeaways, what you need to know essentially from some of the earnings that came out from Home Depot. And one of the things that immediately jumped out to me is how they're looking across the consumer, the state of the consumer right now. And I'll kind of go backwards on this one. That big ticket discretionary pressure, they're saying that continued. You think about some of the categories where this has also impacted Best Buy and Walmart and Target, where they're not seeing some of perhaps those appliances even move out of the in-store capacity or perhaps on that online purchasing capacity. That requires even better inventory judgment and more of a management ability. And I think they're doing that a little bit better year over year here too.
Yeah, the shares are not moving much this morning on these numbers. I mean, if you look at the numbers, they're bad, but they're not as bad as estimated. It's one of those situations. So comparable sales down 2%, both overall and domestically. And the company says for the full year, comps are going to fall 2 to 5%. So they're going to continue to see weakness here. That doesn't seem to be going anywhere. So while these numbers were not as bad as estimated, directionally, this is not great news for them. We talked about the buyback too. I think you mentioned the buyback, the $15 billion.
I did not know.
Okay.
All you.
They did authorize a new buyback of up to $15 billion. So, you know, when you see companies do that, when they report results that are less than stellar, it's sort of them saying like, stick with us. Yeah. This will help you ride it out. We'll give you some, you know, return
reassurance.
Some cash to shareholders. Exactly.
That we are comfortable and confident with the pathway that we've set forward ahead. Yeah. Sure. And that's typically and can be a sort of backstop if you did see some more slippage in either sentiment or even in the share price as reflected perhaps to a certain extent in the sentiment there. But all these things considered for Home Depot and the smaller projects that they did cite as well here. I mean, I consider myself, or at least I count myself in some of those smaller projects. I'm just hanging photos around the house, trying to figure out how I can hang my canvases. So I've got some of those small projects. I did rode my bike to a Home Depot over the weekend recently. That'll show up in next quarter's report, perhaps.
Yeah, we returned something to Home. We bought something from Home Depot and returned something to Home Depot. Their staff is not always the best. Huh. That's what I would say about that.
Great aprons, though.
Unfortunately.
Solid.
Sure. Stellar aprons. Let's broaden it out, shall we? Because interest rates have risen steadily over the last 18 months. What does this mean for your portfolio? Our next guest says quality is king and urges investors to look to the corners of the market still catching up to the market rally. Joining us now is Gargi Chaudhry, BlackRock head of iShares Investment Strategy. Gargi, I do want to start on the retail sales number because that really, was a bit of an eye-popping moment this morning, coming in so much stronger than estimated. What does that tell you? I mean, that feels like more than consumer resilience when you see a number like that.
Good morning, Julie. It's so great to be here. And absolutely, as I was sort of getting ready to appear on your show, I was looking through the retail sales number. Absolutely. Eye-popping is a good word. A couple of things that it tells me. When I look at the breadth of where the strength came from, it's easy to chalk it down to just Amazon Prime, but it isn't. If you look at apparel, if you look at building materials, if you look at just the different categories, I think we're seeing, bars, restaurants, we're seeing strength across categories. And I think that is meaningful. The second thing that I think this is telling us is that despite the 525 basis points of rate rises that we have seen over the last year and a half, I think it's fair to say that the consumer remains on very strong footing. This is a consumption-based economy, 70%, as we know. And that, I think, has us considering what are the risks of recession, if any. Perhaps we all have to rethink how strong this economy is and is going to be for the remainder of this year, and perhaps to a certain extent for the first half of next year as well. So I think this is, one number by itself is not a lot, but I think this number, in addition to so many other stronger than expected data points that we have seen, just shows us that the US economy is in a really strong place and consumers are doing very well despite the rate rises that we have seen.
What does this report tell you about the dynamic right now that we've witnessed in terms of the shift in purchasing from goods to services and how that has continued as a broader trend?
Yeah, so I think a lot of the goods to services dynamic is just the post-pandemic world, right? We all remember what 2020 and 2021 was like with the goods consumption, and it is but normal to see some of that normalization, I guess, to happen in services. I think retail sales is much more of a goods, much more of that is goods based. But even when we look at a few of the services categories, such as the spending in restaurants and bars, that remains robust. And I think the more that we move away from the goods spending into the services spending, the more that we see influence of that in the data. I think it points to a number of things. First of all, normalization of supply chains, that's happening, that'll keep happening. Hopefully that means pressure on goods inflation continues to dissipate. And I also think that at the end of the day, that services spending, to the extent that that continues, will have massive ramification for next quarter's GDP. And I think people will already start revising that higher based on what we saw this morning.
Gargi, I know it's just one number, but given the strength of this number, does this virtually guarantee that the Fed will raise rates at its September meeting?
Great question. And I don't think it is one number, but I think there's just a trend of stronger than expected growth data. And so far, at least 2 months of weaker than expected inflation data. But what does that mean for the Fed? I think that the Fed has been very clear that when they think about raising rates, it's not so much about the growth dynamics as it is about the inflation dynamics. That has been the question, that they have been trying to answer for reporters. And I think that there'll be less of a focus on the strength of manufacturing or the strength of retail sales, and more of a focus on how much further weakening or at least moderation, perhaps, we get on the inflation trend. So we've seen 2 months of point or a little less than 0.2, about 0.16 on the core CPI. If we see another month of that, I don't really think there's a need for the Fed to necessarily raise rates. It's not growth that they're trying to tame. In fact, they want growth to be stronger. They want to, as we know, they did tell us that they now think that they're not as close to a recession. They're not forecasting a recession anymore. I don't think that their intent is to tamp down growth. Their intent is on the inflation front. So if they have this environment where growth is still robust and inflation is coming down, which again, it's a little bit too early to say that, but we have seen 2 good months of weak inflation. If that continues to be the case, I don't think they need to raise rates any further. I think they can pause and see what happens in the fall and then perhaps determine in November if that is time to raise or not.
So, Gargi, let's then circle it back around to rates, right? And rates here, not what the Fed is doing, but what we're seeing in the market. We are seeing rates move higher this morning. We're seeing the 10-year Treasury go higher, yield go higher. How problematic are yields at this level going to continue to be for stocks?
I mean, we've sort of started to see a little bit of that impact. I know we're showing nominal yields right now, but what I think equity markets have historically cared more about is the trajectory of real rates. So adjusted for inflation, what are rates doing? And real rates have also moved significantly higher. So there are two things. One is just the level, and the other is the rate of change. And right now, both have been a little problematic, which is obviously why we've seen equity markets come under a little bit of pressure. I think going forward, there's going to be two dynamics that are going to have an impact on equity markets. Number one, are we going to see a continuation of the growth story? Are we all going to realize that not only have we soft landed, but a recession is far away from our investable horizons, or at least it's not up upon us anytime soon? That will probably be beneficial for certain parts of the equity market, those that are not so reliant upon negative real rates. The second is going to be how quickly do rates keep rising? So we've seen this move over the last month and a half or so, ever since we heard from Fitch and Bank of Japan and the Treasury supply. All of those were big drivers, I would say, of the bear steepening that we've seen. If we continue to see the move that we've seen over the last, call it month or so, I think that does begin to serve a little bit of a problem. So that, we have to balance both. Is the good news on growth going to be driving equity markets, or is it the bad news of real rates, and especially real rates in the longer end of the curve? So balancing that, I would say equity investors should focus on areas of the market that are showing profitability. And we call this quality companies that have ability to have strong margins, that have stable ROE, and really looking at those companies in a higher rate environment make a lot of sense.
And okay, so that started to answer my question of what are the defining kind of parameters of those quality companies. So even as you think further to how companies can continue to display that, even as many of them have kind of moved through periods of either looking at their own guidance and trying to figure out a way that that they could sandbag it in entirety, but ensuring that it wasn't so high as to make a marker that would be unattainable and risk missing then some of that guidance, which could seem far more detrimental.
Yeah, I think that we have to recognize that there has been a slight shift in the markets, right? So where we were thinking about 2023 6 weeks ago versus where we are today has changed. The growth has been meaningfully stronger. Earnings, to your point, Brad, have been meaningfully agreed that the bar was low, but we have still beat. And what we found is, even though we've sort of sales numbers haven't beat as much as we had expected, there's still been overall earnings growth being stronger than what the market had expected. And to a certain extent, the companies that do have better margin have outperformed, have done better. So when we look at our own quality ticker QUAL, we look at how that has performed through this earnings cycle, and we see that outperformance coming because of that margin resiliency. So going forward, I think that there can be periods of volatility in the market, especially going back to my point that I was making with Julie earlier. If we see this rapid rising in real rates continue, I think there can be periods of volatility. Looking at minimum volatility strategies might make some sense. Another area that we are really telling investors to focus on is looking at these equal weighted baskets. So, obviously we know the technology has done very well, but now what about focusing on those areas of the market that haven't done as well? So that catch-up trade, looking at something like EUSA that gives you an equal weight exposure to the markets. And I think that is something that could have a little bit of a catch-up trade. But let's be clear. I think a little bit of volatility, especially if interest rates and especially the long end of interest rates continue to move higher, a little bit of volatility in the markets is to be expected.
Gargi, always a pleasure to get some time with you. Gargi Chowdhury, who is the BlackRock head of iShares investment strategy. Thanks so much for taking the time this morning.
Absolutely.
Well, in a surprise move, China's central bank cut two key policy rates after a broad array of data across retail sales and investments came in softer than expected on Tuesday. As the world grows increasingly concerned about the global ramifications of China's lackluster recovery, will Beijing's latest move be enough to jumpstart the economy? Jens Nordvig, Exante Data Inc. founder and CEO, joins us now. Jens, always a pleasure to speak with you as well. So will it be enough? And is there more stimulus that you expect to come?
So China's economy had a little bounce as a function of its reopening in the first quarter, right? And then that has very, very quickly run out of steam. And the data releases we've seen over the last week or so have been not just weak, but I would say outright alarming, right? They are trying to get credit to flow into the economy, and the credit numbers last week were horrible. Overnight, we had extremely weak retail sales data for Chinese standards, right? So the reopening has clearly run out of steam, and they have big challenges on their hand. I haven't even mentioned that we have extremely severe tension in the Chinese real estate market, right? We essentially have most of the home builders teetering on bankruptcy. So from that perspective, the Chinese crisis in real estate is bigger than the 2008 crisis in the United States. Like, it's a bit different because we don't have a Lehman situation, but in terms of the actual real estate situation is very serious. So now they're cutting rates by 10 basis points. It's hardly a game-changing policy. 10 basis points is not going to make any difference really to what's happening with lending, but it has started to impact the currency, right? It's a signal that they're trying to inject more liquidity, have lower interest rates, and the currency is responding. And this is creating a huge problem in itself, right? Because they want to have a stable currency. So now, last night, we had a grotesque situation where they cut rates, and then they have the state banks intervene in the currency, like within minutes after the rate cut. So I would say we're getting to a point of like incoherence in the policy framework as well, which is not really generating confidence. And you can see, okay, we had a rate cut and equities were down, right? So that's not what you want to see as a policymaker.
Yeah, and speaking of, sort of opacity there as well, listing things that are sort of difficult to understand, they're now not reporting that youth unemployment rate anymore after it rose to 21.3% in June, kind of saying, well, this age cohort, they're students, that's what they should be doing anyway. What do you, are we seeing sort of signs of desperation here? Or how are you reading, when you look at that combined with the policy response, how are you reading it?
Yes, so I think China has a long track record, right, of not being particularly transparent about what they're doing on the data front, right? So when they had a currency crisis back in 2015-16, there was a lot of the most important data they stopped publishing. And the youth unemployment has gotten a lot of attention over the last couple of months, clearly a quite disturbing statistic. So now they stopped publishing that. So that kind of follows a pattern. In terms of the policy framework, I think we have now been through 3 or 4 months where the market increasingly is sort of looking for any sign of any meaningful stimulus, right? And we have, a couple of prices bouncing and that kind of thing every time that there's a bit of hope. But the bottom line is that we've not had really anything meaningful announced. Like, we have various kind of like ideas about things they're going to do in the future, but nothing has really been put very concrete on the table. And as I said before, 10 basis points on interest rates really not going to make much of a difference, right? So we're in a bit of a policy vacuum where there seems to be some internal disagreement about what really should be the policy from here. And that's creating a lag and a delay. And that is making markets very, very uncomfortable. And you're seeing that in the price action very clearly.
For, say, S&P 500 companies that have the largest exposure to China, how will that continue to impact their revenues and some of the moves and actually the lackluster kind of performance that's taken place over the course of this year in China?
Yeah, so I use the market reader technology every day, right, to scan what's going on in the equity market and pick out, okay, where is sort of the epicenter of volatility. And what we've seen repeatedly is that we have these ups and downs in sentiment around China-linked equities, and that can be, FXI ETF, but it can also be the material stock and the stocks that have consumer exposure, such as the luxury goods companies. So we're starting to see some wobbles there, and I think when I look at the data in China, I've been covering China for about 20 years. I've never seen this type of weakness where it feels like you have a real confidence issue where the consumer is starting to get extremely nervous, worried about the future, and holding back. And it was difficult to see it very clearly in the data, right? Because we had that bounce because of the reopening. But under the surface, we have a confidence issue that is very severe. And that's certainly going to have spillovers into stock markets around the world. I'm surprised we have not seen more spillover. Like, given the severity of this, I think you could call it crisis, consumer confidence crisis in China. I think we will see more spillover than we've seen to date.
Jens, speaking of things you probably haven't seen too much during your career, Japan GDP growth at 6%. What do you make of that? I know a lot of it is because of exports, but it also is in such sharp contrast to China. It's really interesting.
Well, there's a lot going on in the market that even if you've been in the market for a while, you've never seen before, right? A lot of people say you should never short JGBs, a widowmaker it's called, right? And it has been the right trade to short JGBs over the last couple of months as they finally started to change policies there. So we have dynamics going on in markets all around the world that are unprecedented. I would say also, if you just think about what's happened this week, where we have, as we've discussed, very serious issues in China that arguably are deflationary impulses, right? And at the same time, we have bond yields breaking up to the top side in the US and in Europe, right? So we have a disconnect between the signal from China and what's going on in the bond markets. But it's probably because the bond markets have become more flow-driven as opposed to just following the CPI prints that would have also suggested lower yields. So there's a flow dynamic going on in the bond market that we have also not been seeing for a very, very long time.
Jens, want to throw one more thing in here. Although this, at this point, certainly is less connected to the rest of the globe, and that is Russia and what's going on with the ruble there tumbling, and then the central bank there coming in, raising the benchmark rate to 12% to try to forestall that. I mean, how should we think about, from a currency perspective and just an economic perspective, how should we be thinking about Russia even at this point, given how isolated it is amidst its invasion of Ukraine?
I think the ruble is a good kind of barometer of what's going on in Russia, right? So we had a period where energy prices were very high. Russia benefited from that. Energy prices have now come down, irrespective of the bounce in oil we've had this year. Russia is generating much, much less energy-related revenue than it was at the beginning of the war, right? So they're under pressure. The war is expensive, and that's mapping into the ruble. We've had a dramatic period of weakness over the last couple of months. That is potentially going to be important for Putin's popularity or non-popularity on the ground. So a very important thing to follow, and showing that Russia's under pressure here.
I just saw a headline that Wells Fargo just raised its U.S. GDP forecast to something like 2%. We got the retail sales number this morning. So to bring it back to the U.S. for a moment, Jens, just finally want to get your thoughts on the data this morning and, again, how we should sort of contextualize that in the bigger U.S. growth story.
Yeah, so I speak to big institutional investors every day, and I have a couple of clients that describe the U.S. economy as the Terminator economy. This continues to come back, and that's very much the case with this retail sales number. It's very strong. A lot of people have been looking for weakness starting this summer, right? It's not happening. Our labor market tracking shows continued resilience, right? So this economy is not dying quickly. Eventually, the rate hikes will have an impact, right? But it's a much, much slower process than people thought. It takes a lot of time for debt to roll. So I think rate hikes really biting is more of a story for 2024 than 2023.
Wow. All right, Jens, good stuff. On fire this morning. Jens Nordvig, Exante Data Inc. founder and CEO, also head of Market Reader. Thank you so much. Good to see you.
Thank you.
We got much more coming up ahead, including the opening bell in just a moment. You're watching Yahoo Finance. Will this most anticipated recession ever actually come?
I think so. I think it's too premature to completely discount the recessionary fears. I think we're still seeing tightening in lending conditions. We're still seeing a lot of that percolating through the economy. I think we will have a recession, but it will be a mild one.
We just had the opening bell on Wall Street, so let's do a quick check of the markets. All three major averages are down. Not seeing a big tumble here, but we are seeing averages under pressure. A couple things going on here this morning. We had the retail sales number coming in better than estimated, so that then leading some investors to wonder about what the Fed's going to do in September, maybe makes it more likely for them to raise rates. And then we also had some commentary around the banks this morning that's causing some pressure there. Brad has got a full rundown over here at the Interactive.
Yeah, taking a look at the major averages here, as you were mentioning, lower across the board to start off the day. Let's take a look at a handy-dandy chart that we've made for you here on the Wi-Fi Interactive. This is a look at the past 2 days, so you can see some of the activity from Monday that is now, with today's movement in the futures, now pushing us into the start of today's trading activity lower by about 0.4%. Nasdaq Composite, you're seeing that down by about a little more than 0.25%, and the S&P 500, that's down by about 0.4% as well here. Do want to take a look at two things. First, sectors, as we always do. We'll get that out the way. 11 S&P 500 sectors. We've got them loaded up for you here on the screen. Down across the board. Not one sector in positive territory. I'm going to zero in on financials for a hot second to tee up this next transition here for you folks. Financials down by about 0.9%. All right, XLY deciding to mess up my flow here. That trickles into positive territory just very briefly as you're tracking some of those consumer discretionaries, perhaps on the back of retail earnings to a certain extent, or retail sales to a certain extent, and earnings. But anyway, getting back to banks, taking a look at the banks here this morning, this coming after Fitch Ratings. They had said, and in a warning basically via interview with CNBC, that U.S. banks, including JP Morgan, could be downgraded if the agency further cuts assessments of the operating environment for the industry. And so taking a look at banks across the board this morning, there is really not a bright spot to be found unless it's NMR, and you don't really talk about that one a bunch because why? Especially with some of the large banks here. You got JP Morgan, that's down by about 1.25%. Also looking across some of the other majors, HSBC down by about 2.25%. Bank of America, 1.7% declines there. So everywhere you look, to quote Full House's theme song, you're seeing that lower pretty much everywhere you look. And then additionally here, taking a look at the Nasdaq Composite, just very briefly to see how some of those mega cap tech stocks are doing here on the day. You've got Apple, Microsoft, and Google all down by about 0.1%. So mirroring each other on a percentage basis here. And then lastly, we'll just ride out with a brief look at retail as we are deep in the depths of retail, well, at least kicking off retail earnings season here. We already got Amazon, that came a week ago basically. And then now looking across some of the other names that we're still ready to hear from, waiting to hear from. I'm sitting on the edge of my seat for Walmart and Target, but Home Depot, let's zero in on them because they reported this morning that's up by about 1.9% right now.
That caused me to look up the lyrics to the Full House theme song.
There's a big debate every morning here. I don't know why we have this debate about who has the best theme song. It's clearly Gilmore Girls. Between Gilmore Girls and Family Matters, best theme songs there. We have like a Gilmore Girls additive voice in my ear that's saying, I think it was Alex. Yep. He voted for Gilmore Girls. One Tree Hill popped in there. We'll put it to our viewers to vote.
I never watched One Tree Hill, so I can't weigh in on
The OC comes up every morning in this debate too.
I don't know. I was just playing the Moonlighting theme song, which is a great one, but you guys are all too young to know it, so.
Family Matters too.
All right, let's talk about some other movers that we are watching right now. Another price change for Tesla. The EV maker has now added lower cost options for its Model X and Model S cars, now $10,000 less than the previous base prices, and this comes after Tesla made previous price cuts in China earlier this week. The shares were down about 1% in pre-market. They were down about 1% when I looked 2 minutes ago at how they were doing, but now they're only down about 0.4%, which reflects that investors, this is not a big part of their sales. These two models only accounted for about 3.4% of their sales, I believe, last quarter. And so this is not a huge thing. It's just more directional here that we have these continuing to push lower.
Yeah, these were two of the models that, of course, really pushed the luxury EV play for Tesla and how they wanted to position themselves and really differentiate their offering when they had first kind of come on the scene within this electric vehicle manufacturing, production, and kind of gathering the mind share of consumer about how electric vehicles could be sexy, could be luxury. But now with more of the market, the mass market Model 3 and the Model Y as well, that takes up the vast and superior, far superior majority of production and deliveries. You were looking at most recently some of the delivery and production numbers that had come out over in July July, so earlier this summer here, but they produced nearly 480,000 vehicles, delivered over 466,000 vehicles in totality. For the S and the X, they only represented about 20,000 of those, and that's being generous.
I mean, these are higher margins, so that's
Yes.
the only thing when you look at the prices going down. That means the margins are going to be squeezed a little bit.
Yeah, and this follows the move that they had made in China just yesterday in that announcement. Also, we're tracking shares of On Running. On Running, they're heading downhill this morning after its net sales expectations fell short of estimates. The athletic brand did, however, raise its full-year outlook and saw revenue rise 64% year over year. Okay, so let's put some color on this. There's some red on the screen there. That's down by about 11.7% for the shares in reaction right now. Some additional color here. They're saying that this is their sixth consecutive record top line quarter. So reach sales reaching net sales of the year-over-year growth rate of 52.3% in this most recent quarter, and then high-end consumer demand, their net sales and their direct-to-consumer, that DTC channel that so many of the athletic apparel and footwear companies have leaned heavily into, knowing that that helps them better maintain that direct kind of relationship and engagement with their consumers. That increased by about 54.7% year-over-year as well within that channel, outgrowing wholesale.
The company also said the strong Swiss franc was one of the things that hurt its sales in part. So that's something to keep in mind here. It said about 3% will hurt, I should say, its sales in the second half by about 3% because of that stronger Swiss franc.
Yeah, we've had a lot of conversations with the CEOs, and stay tuned for our 11 a.m. show. Rochelle Akufo is going to speak with the co-CEOs of On Running on the back of this report. You don't want to miss that. Of course, many of them and the CEOs of On Running, of Brooks, of New Balance, they had talked to us over the past year and said that running is recession resilient, or resistant rather, for consumers who are just looking to get a new pair of shoes and go exercise that way. So we'll see what they have to say on the back of this report.
Yes, we will. Should be interesting. And then our next mover, one of the things that I hadn't really thought about with the Hollywood strike is affecting this company, Getty Images. The shares plunging by about 9%. They were down even more in pre-market trading. The company cut its full-year revenue outlook as it does grapple with the impact from the Hollywood writers' strike. The photo company also reported an unexpected loss for the second quarter and saw revenue fall by over 3%. So, you know, when I first saw this, I thought, well, what exactly is going on here? And it seems like when you don't have certain events linked to this industry, when you don't have movie premieres either, for example, award ceremonies and whatnot, because the actors are restricted from doing any kind of promotion around their projects, you don't have anyone that takes pictures at them and sells those photos. So that seems to be a headwind for this company.
Yeah, the quote on that from Jennifer Layden, who is the Chief Financial Officer of Getty Images, saying, looking ahead, that we're updating our full year 2023 guidance, reflecting the performance through the first half of the year, ongoing macroeconomic and then agency sector pressures there, expected impacts from the U.S. Hollywood strikes. It'll be interesting to see if they add any more color on the call as to how long they're even baking into their financials where those strikes may continue to last. For many of the actors that I follow, at least on social media, and that many of our viewers may see their updates and posts, how they want to get back to work, but it's a matter of making sure that everybody who is represented by the union is also fairly compensated within those roles too.
Here's another interesting thing from JP Morgan's Corey Carpenter, who commented on this. The headwinds concentrated within editorial, with events such as the Emmys being pushed back, but also flows through to creative, where evening talk shows, for example, are not currently consuming content. So you just, I mean, all of us see Getty's photos everywhere. But you don't really think about all of the different outlets that use their content. I mean, we as a news organization use the content as well, but we're not typically using celebrity photos. It's more news. That side of the business not really affected. But again, it's quite interesting. We're going to get an update a little bit later on from our Ali Canal about what's going on with the Hollywood strike, because they are now apparently back in talks.
Yeah, and for those out there that are thinking, what about that AI? Well, they talked a little bit about that too.
Of course they did.
Because that's what people shout at their TV screens these days. In partnership with NVIDIA, they made significant progress bringing to market a high-quality, commercially viable, fully indemnified, creator-responsible generative AI service, expected to launch late Q3 of this year. So that'd be interesting to see how they roll that in and the monetization that can come about with that, but of course, perhaps not as flashy as seeing your favorite actor or actress on the red carpet, and that could impact the business on the other side.
Yeah.
All right, well, we've got all your market action straight ahead. Stay tuned. We're rolling out the red carpet for you at home. We'll figure out how in the logistics. That's coming up on Yahoo Finance. What has been the stock story of 2023?
I would have to say it's AI. I know everyone's saying that, but I would say artificial intelligence dominated Q1 earnings. Certainly when you see the returns, it's been concentrated in a few really mega cap names. But the interesting part of this is, on one hand, it's about artificial intelligence, but then it's also about the fact that these are companies with massive free cash flow generation. So part of it is the story about technology, innovation, AI, but then the other part is, what's the major theme? If you have positive free cash flow generation, you have that money to fund innovation, you have that money to fund further growth, and that's what the market's going to continue to pay attention to.
A grand jury in Georgia has indicted former President Donald Trump as part of an investigation into efforts to overturn the 2020 election. The 13 felony charges include racketeering and election meddling. Let's get some more of the details with Yahoo Finance's Alexis Keenan. Hey, Alexis.
Hi, guys. Yes, so the fourth indictment in a matter of, I think this is now a span of 4 months. This is a state case, though, and it is a criminal case, but it's different from that federal case that was brought a couple weeks ago now in DC, in that it is tied to the alleged efforts by Trump and others to overturn the 2020 presidential election. Now, this indictment, it does contain 19 named defendants, including Trump, and that includes, as you mentioned, Mark Meadows, former White House chief of staff for Trump, and also his lawyers Rudy Giuliani, as well as John Eastman. And this is a very heavy indictment. It has 42 counts in it. Among those, 13 of them are alleged against Trump. And the main basis here is racketeering, organizing with others to go forward with some type of criminal enterprise. Also, though, charges of conspiracy, soliciting a public officer, false statements, impersonating a public officer, forgery, filing false documents, and attempts to influence witnesses. There's one claim that on January 2nd, the allegation is that Trump had called Georgia's top election official, trying to pressure that official into changing the election by ways of saying that there were false votes submitted, that Democrats were falsely stuffing ballot boxes. And remember, Georgia was a really important state, as it often is in presidential elections. In this particular 2020 election, Georgia was a 49-49 and change vote on the popular vote on each side for Biden and Trump. So that was a critical state to target if you did want to have a different outcome of that election. Now, Trump is facing these indictments and these charges. And look, the timeline is going to be very fraught in terms of it riding alongside the primaries for the 2024 election and all the way up until the election. In the federal case that he's got coming up in D.C., he's also got a federal case in Florida. So the D.C. case is the one that is similar to this one. Then you've got the Florida case alleging that he kept classified documents after having left office. And then on top of that, you have the New York State case that alleges that he falsified documents in those alleged hush money payments to Stormy Daniels. So that timeline, it starts in March. The first trial is slated for March among those, and that doesn't even mention the civil cases that Trump is also going to face in this coming year. And then going along, it should be approximately a year when these cases would be set for trial from the date that they are filed. So you can imagine, starting in March, that this will run right alongside the actual primaries and through the election, most likely.
And it's my understanding that as a state case, whereas in the others, he could receive a presidential pardon, maybe even from himself, it's unclear.
Right.
This one he cannot, because it's a state case instead. How should we, so you sort of helped us situate these in time. How should we situate them in severity and, how much jail time each carries and sort of how firm the cases are?
So in Georgia, racketeering has a lower bar than it does at the federal level. It does not require as tough of evidence to show in order to get over the hurdles of proving your case. But all of these charges, a lot of them are 20-year imprisonment at their max sentence. Now, look, defendants don't usually get the maximum sentence, but if you stack up enough of these charges, if they do lead to convictions, these for Trump would mostly look like a life sentence. Well, look, we're at really early stages here, but there are so many charges that he's going to have to defend. And so he has a lot of work ahead of him. And certainly I would expect that would frustrate his efforts to keep campaigning, no matter how much different experts might think, legal experts might think that he might use these lawsuits to drum up more support from his supporters and more money perhaps as well to keep his bid going.
Yeah, I mean, that's something our Rick Newman likes to point out, that every time an indictment drops, he raises a bunch of money.
Yep, polls go up.
Exactly. Alexis Keener, our legal reporter, thank you so much for helping walk us through that. Well, stocks are in a funk, bond yields are elevated, the specter of inflation still haunts us, even if a little bit less, and there's a big question mark over the world's second biggest economy, as we talked about earlier with China. Sounds like it could be maybe a stock picker's market, but where are the opportunities as the summer limps to a close? Joining us now is Jonathan Boyer, president of the Boyer Value Group and host of the World According to Boyer podcast. Thanks for being here.
Thanks for having me.
So I'm sure you would like it to be a stock picker's market. I guess in some measure, you can always make money picking stocks as long as you pick the right ones. How do you think about it in what has been, yes, stocks are rolling over a little bit now, but is your framework any different in what looks like a very resilient market and economy than it is at other times?
I think as best you can, you really have to drown out all that noise. I mean, if you had listened to the quote unquote experts at the beginning of the year, you would have missed out on an unbelievable rally. So I think you have to break it down onto a stock by stock basis. It's obviously self-serving for a stock picker to call it a stock picker's market. I think it's a time though where people who know what they're doing, who do the work, who are able to do the research and can end up making a lot of money, but you have to be careful. There's a lot of minefields out there, and there are a lot of stocks that are unbelievably expensive that I would avoid, but there's also opportunity.
And so where are you, and have you already been able to see some of that opportunity be capitalized on to this point in the year?
Yeah, no, I mean, it's been a good year. I mean, a lot of our picks, fortunately, have done well, but I still think if you look at a lot of the names that we look at, let's say Liberty Braves, for example, which owns the Atlanta Braves baseball team, you know, it's $37, $38 stock. We think it's probably worth $55, $57. It has a hidden asset in the sense that it has valuable real estate that's not properly reflected on the company's balance sheet. And we think in the next couple of years it'll be sold. So there's opportunities out there. You just have to be patient, which is the hardest thing for most investors.
Yeah, although the stock has gone up a little bit. You talked about it last time you came in to see us. You mentioned hidden asset, and that's something you outlined recently in a Substack, and I take it that has been a long time method of the firm to try to find value, started by your dad,
Yes.
Is that right, Mark Boyer? So basically, you look at a company, you try to find something on its balance sheet that is not necessarily visible at first glance. How does that work? How do you even go about doing that with all of the companies that are out there?
Exactly. You have to be a detective, and that's what my father, Mark, has really taught me. One of the very first stocks, he started the firm in 1975, was Tiffany & Company. Tiffany & Company, you could have bought the whole company for $30 million. That's everything. The building that it owned on 57th Street and 5th Avenue or whatever street it was on was worth more than the entire market value of the company. But if you were just looking at the balance sheet, you wouldn't notice that because generally accepted accounting principles, which is what informs financial statements, had it at historical cost. And that's just not a relic of the 1970s. That still happens today. There are companies that have great brands underneath the corporate umbrella that many investors miss out on just simply because they just don't know what the company does. Sounds simplistic, but it works.
So one of those companies, Acushnet, and I love this one personally because my weekend warrior within me tends to pander towards one of the most difficult and painstaking sports in golf, and Acushnet is one of those companies as well.
Yeah, it's a terrible name, and I would save them millions of dollars on a McKinsey survey and say they should change the name because I took an informal poll of professional investors after we did our report and said, do you know what this company is? And no one heard of it. No one knew what they did. They own Titleist golf balls and FootJoy golf gloves, among other great brands. And that actually leads to valuation discrepancy. And we outlined that in the Substack article. That has worked out. But there are other names that still are cheap that have hidden assets. A company like IAC that owns Toro, which is a car sharing service that is on its book at historical cost, even though its stake is worth a lot more than that. So there's lots of examples. You just have to be willing to do the work, and it's one of our favorite methods to use. And
then additionally here, I mean, what differentiates, even if you look at Acushnet and say, yeah, they have a horrible name, but they still have these underlying subsidiaries in Titleist and FootJoy that in the golfers boom that we've seen kind of mid and post-pandemic now, what do they benefit from that a company in Topgolf Callaway doesn't benefit from?
They both should benefit. I mean, they're
very different stock charts that we are looking at over the course of this year, by the way.
Yeah, absolutely. And I think Topgolf Callaway Brands is, as ticker MODG, is at these levels a much better value. Acushnet has worked out, but I think Topgolf has different exposures because they own the Topgolf franchise, and that's been depressing the stock a little bit. But a pure play golf equipment manufacturer like Acushnet has done quite well. So the opportunity right now, I believe, is in Topgolf, but Acushnet's still interesting as well.
On the real estate side, have investors gotten more savvy? Because it feels like when you talk about the mid-70s not realizing the value of Tiffany's real estate, I do feel like it's more topic of discussion now. Oh, they haven't unlocked the value of the real estate, right? Is it tougher to find examples of that now?
That's harder. You have to be a little bit more creative. But for example, 2009, Saks Fifth Avenue was selling below the value of the real estate it owned on Fifth Avenue, and that ended up being taken over by Hudson Bay. So these things happen. You just have to be opportunistic, and you don't have to swing at every pitch. You have to find ones that have catalysts that, if you're patient, will do well over time.
Are there any other ones that people should be watching out for?
Madison Square Garden Entertainment, which was just spun out with the Sphere, owns the air rights above Madison Square Garden, which are extremely valuable and not really reflected on the company's balance sheet. Right now, obviously, New York real estate's in the doldrums, but if you're patient and you believe that there's a reason why people will come to work every day, those air rights could be unlocked.
Are there any regulatory reasons though that those couldn't be unlocked?
I mean, it's always, you have to deal with the city council,
Right.
et cetera, but at some point in time, if they wanted to sell it, they probably could.
Oh, interesting. All right, Jonathan, good to see you. Jonathan Boyer, president of the Boyer Value Group and host of the World According to Boyer podcast. Appreciate it. We got much more coming up. Stay tuned. You're watching Yahoo Finance.
This earnings season, has it lived up to expectations?
I think it's been fine, but I think it's been a little bit soft. So I think the problem is we got used to all these positive surprises and coming out feeling really good, and we just haven't had that.
It's just after 10 a.m. in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman. We are about 30 minutes into the start of trading. Here on the day, let's take a look at how stocks are moving right now. Down day for stocks. Weak data from China and a surprise rate cut from the PBOC weighs on sentiment. July's hot retail sales report adds to the food for thought for investors.
Yep, and they're not liking what they're tasting right now. Let's take a look at home builders also. D.R. Horton on the move after a filing from Berkshire Hathaway showed the company bought more than $700 million worth of the stock. It also saw 37% year-over-year increases in sales order in the last quarter, sales orders. Shares of Lennar also moving. They were also on that Berkshire buy list. Berkshire, though, does own significantly fewer shares of Lennar.
We're also taking a look at Arena Group Holdings this morning, the media company that is home to brands including Sports Illustrated, The Street, and Men's Journal. Signed a letter of intent with Simplify Ventures. It signals a potential acquisition of a media subsidiary which would increase Arena's network distributions.
And shares of Sea Limited are underwater after they released their quarterly earnings this morning. It is not a shipping company. It is an internet company. It's Singaporean, and it lost on both top and bottom lines. Its CEO, Forrest Lee, said on the call that the company will boost investment to core e-commerce businesses, but that they have strengthened their execution capabilities and increased the stickiness of their ecosystem, whatever that means. The shares are down 25%.
They're under the sea.
They are. U.S. retail sales came in much hotter than expected in July, driven by a boost in e-commerce in particular. Joining us now to break down the highlights, Yahoo Finance's Josh Schaefer. So, Josh, what do we see here?
Yeah, Julie, so I'm right next to the headline numbers right now. So you see the big beat that we had just overall. So retail sales in July up 0.7%. Estimates have been for 0.4%. And then when you take out auto and gas, retail sales up 1%. Again, estimates had been for 0.4%. So a pretty significant beat for the July retail sales report and significantly higher than we saw in June. Remember, in June, this 0.7% number was just 0.2%. But I want to take a look at what has happened over the last couple months as well when you look at how retail sales have remained resilient. You remember in March, retail sales for the month fell 1%. This is when a lot of people right around in March started circling, okay, here comes that consumer slowdown. What's going to happen in April? What's going to happen in May? Well, look at this. We've been pretty consistent now, 4 straight months of gains, and a 0.7% gain in July is not nothing. And it sort of gets to the story we've been talking about a lot this summer about the resilient U.S. consumer. And then another interesting thing in this report I want to dig into is what did well and what didn't do well. And when you take a look at the categories, remember July has Amazon Prime Day. Amazon Prime Day, a big online sale. Not a surprise to see e-commerce leading the way here, up 1.9%, up over 10% compared to the same period last year. So potentially a very big month for Amazon. We know they did well. They said that the sales did well, but curious when we get to next quarter's earnings, sort of how that plays out. And then to get a little bit more corporate on what we're looking at here as well, we had Home Depot earnings out this morning. They flagged that people are still not buying those big ticket items. They're seeing a slowdown there. Well, let's take a look at furniture down here, what Home Depot sells, right? Some of that porch furniture, things like that, down 1.8%. And then you see electronics down 1.3%. Remember, we're going to hear from Target and Walmart later this week. Last quarter, Target said discretionary spending was starting to slow down. Interesting to see this number down 1.3%. Curious what we hear about that discretionary spend. Right now, it seems like the narrative we're seeing in retail sales is people are still spending, but not necessarily on the things that they don't need. And it'll be curious to see how that continues to play out as we still look for this consumer slowdown that's maybe materializing, but maybe not as much, Julie, as people thought.
Or in different places, right? Like, and you mentioned Target and Walmart from that electronics number, but we're going to hear from Best Buy next week also. So that'll be obviously very closely pegged to that. Thanks, Josh. Yeah.
Switching gears, Home Depot stock slightly higher after reporting a 2% decline in sales in its second quarter. Home improvement retailers just wrapping up its earnings call. Joining us now with some key takeaways from the call is Yahoo Finance reporter Brooke DePalma. Okay, Brooke, tell us more.
Well, good morning, Brad. Good morning, Julie. I mean, certainly Home Depot here giving us an inside look at the state of the economy and the state of the U.S. consumer. As Josh just noted, we're certainly seeing a slowdown in discretionary spending among consumers. Consumers buying smaller ticket items. They did say that they're seeing strength in project-related categories like building materials, hardware, and plumbing, but once again, pressure in those big ticket items. Some optimistic outlook for the second half of the year, saying that the Halloween outlook is looking promising. pricing, but certainly weather having to do a lot with it as customers look for exterior painting and stain. But going forward, they said that there is a healthy consumer segment for this demand at Home Depot in the overall environment. Also, bright side for lumber deflation, prices there decreasing by over 40% for framing lumber. They did know from a larger perspective that inflation has certainly abated. Commodities is certainly down meaningfully from a peak year over year. They said we're not expecting a deflationary environment, though, and they're kind of settling in these non-commodity price levels. But the big takeaway here, too much uncertainty to update guidance here. CEO Ted Decker saying from a more macro perspective, they expected after 3 years of explosive growth, they expected 2023 to be a bit more moderate. They do say that consumers remain resilient thanks to strong job growth and wages. They also noted that inventory is better and their value proposition is good. But they reaffirmed their guidance, full year sales to drop between 2 to 5% compared to fiscal 2022. And that's because Ted Decker said that there's lots of uncertainties that remain. They don't know how quickly or further the share shift in consumer spending will occur and whether or not that home improvement sector that we saw boom during COVID will ever come back. And in addition to that, they're also weighing on monetary policy actions to really see how exactly the consumer goes into the second half of this year.
So let's circle back to the big ticket purchases that you mentioned that they emphasized both on the call and in the statement. Tell us more about that. What are we talking about here?
Yeah, well, certainly we're looking at more, big ticket items in terms of appliances that we saw really make headway as far as consumer spending went during COVID. But now we're seeing a sort of a backtrack to there. And the executive vice president of merchandising did give us some details on the call. Here's what he had to say.
Big ticket comp transactions, or those over $1,000, were down 5.5% compared to the second quarter of last year. After 3 years of unprecedented demand in the home improvement market, we continue to see softer engagement in big ticket discretionary categories like patio and appliances that likely reflects both pull forward of these single item purchases and deferral.
And so really looking forward, Home Depot really weighing on monetary policy actions to determine whether or not consumer sentiment will change in the latter half of this year and if they will have further pricing power to ultimately, go back and spend more on items that they did maybe a few years ago.
Brad's got some sticker shock here. He's looking at robo-mowers on the Home Depot website.
I'm just saying, back in the days of B&W Lawn Care Services in Westchester, Pennsylvania, I would have absolutely invested in one of these and just taken them from lawn to lawn. That was one of my clients, I
have not seen those at all at work in my suburb. There are definitely still people behind them, but they did just ban gas-powered mowers. Hallelujah.
Interesting.
Not everybody's following the ban.
These are eco-friendly.
I'm very glad.
Yeah,
electric is the way to go.
We'll have to see those if those are in the inventory because Home Depot definitely doubling down on that inventory as well. They did also say that they're pleased with the progress that they made. They said the inventory turns about 4.4 times, down from 4.5 times from last year. But I don't know if those robos are on store shelves in a high capacity.
No, I think they probably
the demand might be from you, but not from everyone.
You got a Roomba for the inside of your house. I'm just saying, you might need an EcoFlow mower for the outside.
It makes sense. All right, thanks, Brooke. More weak data out of China weighing on oil markets as investors fear a slowing in demand. The world's second largest economy saw retail sales rise by a modest 2.5% compared to the prior year. Industrial production rose by just 3.7%, both of those prints coming in below economists' estimates. Ahead of these data releases, China's central bank cut a set of key interest rates in a bid to spur growth. Joining us now is Vandana Hari, who is Vanda Insights founder. It is good to see you. So as we look at China and as it relates to oil here, how much of a headwind is the slowing growth there going to be for oil prices?
Good morning, Julie. So Chinese economy has been sputtering without doubt. We have had months of disappointing, weak macroeconomic data. Something that has bucked that trend has been Chinese crude imports, the refining rates of the country and consumption, end user consumption, all of which has been quite healthy. Mind you, does come off a comparative low base of last year, but relatively healthy. But if you look at everything else on the macroeconomic front, whether it be their exports, their industrial production, manufacturing activity, deflationary pressures, all of that is just big bad news in bold letters. It hasn't really weighed on crude prices as much as one would have expected, because the major counterforce has been right there in your country. Since the start of July, we've seen quite an upturn in sentiment with regard to the U.S. economy, and that has that's been an overpowering influence in crude. But looks like prices have hit the skids today. So, it might be that the Chinese pessimism is coming home to roost finally.
What are we still to extrapolate from the relationship that ensued post-Russia invasion of Ukraine and the China-Russia relationship that had ensued there? Where does that stand right there, and how are investors best to continue evaluating that?
Yeah, it's the entire scheme of things with regard to Russia, the Western sanctions, the embargoes on Russian oil has unleashed an unprecedented rewiring of trade globally. And, within that, again, we've seen China and India step up as major crude buyers from Russia. And of course, all of that crude has moved away from the European markets. So within that, China and Russia were always were close, geopolitically close, and trade-wise as well. Of course, they share a major boundary between them. So there's not just by sea, but pipeline imports of gas and crude from Russia as well. They do a fair amount of trade in their currencies as well, ruble and yuan instead of the US dollar. So I guess it was not surprising that the two countries have gotten even closer after the sanctions. And look, at the end of the day, for countries like China and India, if they're getting cheaper crude, especially in high price environment like we saw last year, and even this year's prices are relatively high for these price sensitive countries, they're just going to buy all the Russian crude and oil that they can get their hands on.
So when we look at the trajectory of prices globally, do you think that we will, despite the pause that we're seeing today, do you think we'll continue to move higher given the U.S. demand, given the Saudi production cuts, for example? Is the path still going to be upward?
So, Julie, there are definitely price supportive factors. As I mentioned, as long as the optimism over a soft landing in the U.S. survives or is alive, I think that remains a major supportive factor for crude price sentiment. After all, the biggest economy and the biggest oil consumer as well, the U.S. And of course, the OPEC plus cuts. I think those two are major supportive factors. However, I think in the last few weeks, as we've seen crude head towards 7-month highs for Brent, 9-month highs for WTI prices, I think they have heavily discounted not just the economic sluggishness in China, but the downturn in Europe as well. So I did not expect, and I still do not expect crude to have much of an upside from current prices. At the same time, I don't see a very major downward pressure either, as long as, OPEC plus cuts will remain. I think they are quite determined to make sure that they tighten the market, that they see inventories going down through the second half of the year. I think that the real tipping point here might be if we see anything happening that changes the sentiment, the level of sanguinity and optimism that we have in the markets right now with regard to the U.S., that could be a major downward pressure on crude. But all said, I don't see any reason for it to go much higher from here or much lower.
We've seen continued repricing of expectations to come out of China for this year, the latest one coming this morning from Goldman. And so for investors that are trying to best figure out where everything from crude prices to commodities that are impacted to even some of the equity market players that have the largest revenue-based exposure within China are thinking about this, from your perspective, what if any pivot is apt to be able to be making right now in this environment?
Yeah, that's a big question, Brad. So in this part of the world, of course, Indian markets have been doing phenomenally well. I think the Indian economy is running full steam, and that's a good place to invest. China, unfortunately, I think is going to take a long time to recover, and certainly to regain the pre-COVID momentum that the economy had. A lot of the problems that we are seeing in China today, of course, some of them have been exacerbated by the unprecedented nearly 3 years of strict zero COVID policy and lockdowns, but a lot of them predate COVID. The property market, for instance, is, these are very systemic structural problems that are going to take a long time. You might see headlines, analysts saying routinely that whatever little stimulus that is coming, fiscal or monetary, in drips and drabs, is just not enough. And I subscribe to that as well. The government is being very careful not to overstimulate, not to add more debt to the economy, because that is already a problem, and that was already a problem in China, unfortunately, even before COVID. So it's going to be a very, very slow uphill climb for the Chinese market and the Chinese economy.
Vandana Hari, it's always good to get your insights on these topics when it comes to the oil market. Really appreciate it, especially at after 10 p.m. in Singapore, I believe. Vanda Insights founder, thanks again. Really appreciate your time.
Thank you so much, Julie.
We've got much more markets action coming up. Stay tuned. You're watching Yahoo Finance. What sector of the market do we not pay enough attention to?
Consumer cyclicals. I think people we want to know where the economy is going. That's one of the best ways to find out where people are spending their money on discretionary purchases, so I guess consumer discretionary as well. Let's see where those are going, and that'll tell you a lot about how the consumer, which is 2/3 of the economy, is going.
Credit rating agency Fitch warning it could slash ratings for dozens of lenders, saying those comments in an interview with CNBC, marking the latest sign of turmoil for the industry. Fitch initially cut its overall assessment of the banking industry back in June and cautioned another downgrade could trigger a reevaluation of more than 70 U.S. banks under its purview, including major lenders like JP Morgan Chase and Bank of America. Fitch's warning comes just 1 week after Moody's downgraded 10 small and mid-sized banks. Joining us now is John Heltman, American banker, Washington bureau chief. John, I've been trying to sort of put this in context this morning, right? Because Fitch did the same thing that Moody's did in saying it was these banks were on watch for possible downgrade. Nobody sort of noticed at the time, just like nobody sort of noticed when Moody's did it a few months ago. You guys at American Banker probably noticed, but the broader market didn't notice.
To be fair, there was a lot going on a couple months ago. So.
Yes, exactly. So, how seriously should we take this warning? Is it going to happen? What effect is it going to have?
Well, I'll just start here. Credit downgrades are bad. They're not good. So that is something definitely worth paying attention to. I think that there's a couple of things going on here. One is, if you go back all the way to 2011, I think it was, when S&P first downgraded the U.S. sovereign debt, ratings agencies tend to kind of move together, right? Because they're looking at the same things. And so having just one ratings agency out there kind of downgrading U.S. sovereign debt for 10 years plus sort of indicated that when Moody's kind of made its move, Fitch made its move last week, what that sort of means is that if the U.S. sovereign debt isn't as good as it used to be, then things like banks that are sort of in some ways subordinate to the credit of the country they are in, those will naturally kind of have to adjust downward as well. So that's part of it. The other part of it is that banks' margins are getting squeezed in this sort of interest rate environment, right? So it now costs more to get your deposits. That's what you use to make loans. And you also have all these loans on your books that are at lower interest rates than what the prevailing rates of right now are. And of course, you have the economy sort of cooling. So loan demand is also going down, making it harder to replace your low interest bearing loans or assets with higher interest bearing assets. So all this is of a piece. And what do I make of it? I think it seems like what it makes is it makes an already sort of tense lending environment just a little bit more tense, and makes the margins a little bit more thin at a time when we're also looking at maybe commercial real estate having a big drop off. That sort of, or any sort of external variable that could create more uncertainty in this area is just all the more dangerous.
And so from your perspective, and just trying to summarize this too, is this a result of Fed policy or more a result of bank management?
I think it's certainly the rising interest rates over the last year is the proximate cause of all of this. That's what's making banks' costs of funds go up, thus squeezing their margins and so on and so forth. But at the same time, the Fed isn't doing this to hurt banks. They're doing this to get inflation under control, which is, arguably as or more important than banks' profit margins.
And something else that you're covering, by the way, that I want to turn to is using U.S. lender or borrowers' data, I should say. And this is something that the Consumer Financial Protection Bureau is taking a look at. What do we need to know about it?
So the CFPB has said they're going to put out a proposed rule on data brokers. So the CFPB has explicitly declined to say what companies specifically would be affected by this, but it's a lot. So anyone who does data aggregation, data brokerage, think your Googles, your Amazons, but also lots and lots of fintechs are in this space using kind of consumer data and selling it for advertising, all sorts of different things. What this rule would do is sort of say that this kind of data collection of kind of credit related information can only be used for credit related purposes, not for advertising or for whatever else. And that is definitely going to affect a lot of sort of big data firms were this to be finalized.
How will this impact some of the social media companies where more transactions are taking place? There is more alternative data, perhaps, that they're able to carve out and really index and fine tune based on interactions that take place and engagement that take place on their website. And for some of that, they're able to monetize that and ultimately turn that into not just their own method of monetizing it, but a mechanism for having a commerce type marketplace on their platform.
So I would assume that, you know, your Metas and your Amazons have very smart people who can figure out how to, you know, say to continue to operate some level of data sharing, even under this rule. But the rule itself seems pretty chilling. It basically says you can't sell consumer data. Now, you can't sell consumer data without their consent. So maybe you could get people to consent to things, but yeah, it'd be pretty drastic. Now, the one thing that's interesting about this is that were this rule to be finalized and then for a Republican to take the White House in 2024, there's potential, and for Republicans to take the House and Senate as well, you could pass something called the Congressional Review Act that would nullify this rule. However, unlike most things that CFPB does, this actually has a lot of bipartisan support. A lot of people in Congress on both sides of the aisle are pretty sick of the way that data companies kind of buy and shares personal consumer information with, in a lot of cases, without their consent.
This is really interesting. John, thanks so much for helping us break this down and reporting on this morning. American banker, Washington Bureau Chief Jonathan Helpman. Appreciate the time as always.
Thanks.
All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
What is your favorite chart or indicator right now?
Favorite chart or indicator? I mean, it doesn't signal good things, but I continue to be kept up at night by the yield curve inversions. They've stayed really deep. They've been here for a long time. They don't usually signal clear skies ahead, so watching that for what happens when they start to re-steepen, that usually does inflict pain on the equity market.
Grove Collaborative, an e-commerce retailer selling eco-friendly household and personal care products, reported second quarter earnings yesterday after the bell. Orders, active users, and net revenue, they all fell from the year prior. The company attributing the dip to lower advertising spend throughout 2022 and 2023. Since going public in 2022, the going has been tough for Grove. Falling revenue hit the company's stock price, calling into question if Grove would be able to stay listed on the exchange. But Grove has some believers, namely Volition Capital, which announced a $10 million investment in the business. Volition Capital was previously throwing its investment support behind investor-driven brands like Chewy and Chamberlain Coffee. Grove also unveiled a series of leadership shakeups. Co-founder Stuart Landesberg will also step down from his current post as CEO to become executive chairman, and Volition Capital co-founder Larry Chang will soon join the company's board. Both join us now. Great to have you here with us this morning. Stuart, we'll start things off with you. When you think about the next wave of kind of innovation that the company needs to showcase, and where, even in the changing of the guards, if you will, you expect that, and the management team expects that to come forward, where are some of those investments going to be thrust towards?
Thanks so much for having me. And, I listened to your intro, and I think the quarter, yes, it was down on the top line, but we've, over the last year, taken huge steps to listen to our customers and drive innovation that creates long-term value. And so we've doubled down on our most loyal community, and that's actually allowed us to get much, much closer to profitability, posting record adjusted gross margin in the quarter and getting closer to profitability than we've been since the height of the pandemic. But in terms of innovation, really where we're focused, I think, is on two axes. The first is, how do we deliver even more value for our best customers? And we announced, as part of our growth and market expansion initiative, our GME plan, that we were launching the VIP Hub, which makes it easier for our best customers, our VIPs, to access all of the incredible perks of Grove, new products, free gifts for VIPs, new collections, discounted bundles, etc. That's the first leg. And the second leg of innovation will be, how do we bring folks into new categories with lower barriers to entry to sustainable products? So that means finding lower cost entry points to zero plastic and zero waste products, and moving consumers into new high potential categories for us, like health and wellness.
Larry, I want to ask you why you got into this. I mean, because I know that Stuart here is optimistic about the path for this company, but it wasn't just sales were down, active customers fell by 9% as well. So looking at, what do you see in Grove Collaborative that made you want to get in here?
We see a $200 billion market in household essentials that's going through a secular shift from conventional products to sustainable products. And we see Grove as the company that's been leading the way in that shift for over the past decade. And they're very well positioned to lead for the next decade forward. They're the #1 market share in terms of brand and sustainable household essentials. They have a 1 million person community that's very active. That's a great foundation. What you see in some of the near-term financial results is just the shift from a time when capital was free and cheap to a time when companies are focused more on profitable growth. And Grove and the board and all the execution that has taken place has demonstrated tremendous progress in that direction. They did have their first operating cash flow positive quarter in their history last quarter, and many of the underlying metrics are going in the right direction for profitable growth in the future. So we think there's a promising market dynamic and very good execution under the hood if you look into it.
What products do you expect to need to add on to the portfolio that you're able to take to clients and customers who are looking across the Grove solutions that they could bring into their household? Where do you want to lean further into that and perhaps even add on to that? Larry, I'll go to you on that one.
Health and wellness is a big category that we have added to the platform. These are your vitamins, supplements, probiotics, other food supplements, and so forth. It's a higher spend, higher margin category that we see as very strongly recurring. You've seen that Grove's cohorts and their customers have been very stable for 6-7+ years, and we think this will only add to that.
Stuart, I want to ask you about the bigger market opportunity. I have to cop to being a customer of one of your competitors, but I like reusable soap dispensers and stuff in my home. I was caught by some statistics in a recent New York Times story that pointed out that we are seeing a surge in sales of reusable water bottles, but we're also seeing a surge in sales of single-use water bottles. So sort of what's your bigger thinking around, like, how open people are really to making these kinds of shifts away from plastic?
I think this is the key question. If you look at our markets, as Larry said, $200 billion. And moving away from single-use plastic, of course, is challenging, but it's an issue where there's incredible consensus. 84% of the US wants to see us take action on single-use plastic. It's hard to get 84% consensus on any issue in this country, much less an environmental.
Well, I mean, I'm sure people will say that in theory, Stuart, but then when it comes to actually buying the stuff, that's another question, right?
Well, that's exactly where companies like Grove come in, because we have to bring products to market that are affordable, that are convenient, that work as well or better than whatever the alternative is. And so when you look at our category, right, if the dish soap comes in aluminum, which is recyclable forever, or if there's a refillable glass bottle, that's great. But if it's not getting your countertop or your dishes clean, nobody's rebuying that. So at Grove, we've always put efficacy as an absolute priority, because you're totally right. Just having the sustainability innovation may not solve the consumer's need. But we believe, and we've seen a lot of growth over the last several years in this, on the back of building products that aren't just sustainable, but really deliver for the customer in terms of efficacy, fragrance, price point, et cetera. And I think that kind of innovation is what's going to get people from wanting to make the change to actually driving change in this massive market.
Larry, do you think there's going to be or need to be a moderation in terms of the pricing strategy going to consumers, as consumers have continued to display that they may not be breaking, but they are bending, as Jordan Jackson put it to us from JP Morgan recently in our conversations?
You know, one of Grove's great wholesale partners is Target, and that's the consumer that I think is the right price tier for the Grove customer. So I think there's always going to be folks that are super high end, and there's certainly products that live in that zone. Grove is not in that zone. And there are obviously lower end grocery store products where Grove does not live. So I think Grove is right there in the middle. I do think there are many drivers towards consumer spending and shifting towards sustainable products. There's state level legislation, there's city level legislation. We've even talked to the executives from all of the major CPG conglomerates, and sustainability is a top 3 priority for nearly all of them. So the tailwinds are there for this segment, and Grove just needs to continue to execute, delight customers, and they'll be in good shape.
I am curious, and this is a little bit backward looking. You guys came public in 2021. It was not a good year for many companies that came public, unfortunately for them, that year, and the share price has collapsed since then. Is there any thought to coming out of the public markets? What is the utility at this point of being a publicly traded company rather than sort of operating privately as you build towards profitability? Stuart, I'll ask that one to you first.
We don't comment on sort of transactions that potentially could take the company private or anything like that. But what I will say is that private or public, our focus is on profitable growth. And I think Larry said well that a lot of companies, Grove included, got out over their skis believing that pandemic trends in spending were going to continue. And we were not alone, but we certainly got wrong how much we expected the trend towards e-commerce to continue. And we had to retrench and rebuild the company for profitable growth. And I think public or private, what our stakeholders care about are we delivering quality products to our consumers with a great experience that drives long-term loyalty? Are we delivering on our sustainability mission? And are we setting the company up with a foundation financially and in terms of the product we bring to market that can drive long-term, durable, profitable growth? Because that really is what we're building for today. And so public or private, I think that will be the thing that drives value for all stakeholders over the long term.
We have seen a little bit of a movement here, though, in the most recent retail sales data around e-commerce and digital sales, showing that there still is a lot of strength there. How does that perhaps reposition or even reinvigorate the internal discussions around where digital will drive perhaps some of the strategy going forward, Larry?
Well, there's 2 words to profitable growth. There's profit and there's growth. And I think right now, where many companies, including Grove, are focused on profit. But you're right, the secular tailwinds of e-commerce are as consistent as the secular tailwinds for sustainability. And there's going to be a time when companies like Grove and others, they've got their cost structure in the right place, they've got their efficiency metrics in the right place, where it will be time to grow again. And e-commerce and digital will continue to be one of those channels alongside wholesale and Amazon and others for a company like Grove.
Guys, thanks a lot. Stuart Landisberg, Grove Collaborative co-founder and executive chairman, and Larry Cheng, Volition Capital co-founder and managing partner. Thanks so much.
Thank you.
Pleasure.
Hollywood is offering writers a new deal, specifically focusing on the issues surrounding artificial intelligence. That's according to reporting by Bloomberg. That's as the strike continues to plague the industry. Yahoo Finance's Alexander Knell joins us now with details. So we haven't heard anything in a while about the two sides talking. What's going on?
Well, this is certainly good news. The two sides met on Friday. The WGA said that they are reviewing the proposals. Bloomberg says that they will be meeting with studios to discuss that today as negotiations are ongoing. But according to this report, it seems like everything the writers wanted, the studios are at least giving some concessions on. You mentioned artificial intelligence. The studios said that they've agreed to ensure that humans are credited as writers of screenplays rather than replacing them with AI, since that was a top concern. There's also more visibility when it comes to streaming data, the amount of hours that are viewed on a particular show or movie that is on a streaming platform, since that was important to writers. There's also been a 20% plus increase in residual payments for shows that appear on other networks that they weren't originally intended for, along with salary increases and a minimum duration for writers that work in mini rooms. So mini rooms are a small group of writers that basically work on a show before they're picked up by a network. So, this seems to hit all the boxes. However, the writers have been very steadfast in their language. And if they are not receiving everything that they want from the studios, they're going to reject this proposal. Bloomberg said that Netflix co-CEO Ted Sarandos, along with Bob Iger, actually from Disney, they've been pretty adamant that they need to get a deal done sooner than later. We are well past that 100-day mark. The longer we go into the summer and into the fall, that's going to affect the programming on both the TV side as well as the movie production side. So we'll see if this deal can get through.
Right. So is there anything within these discussions that we could probably or perhaps safely apply to where the conversations would move forward on the actor side, on the other side of this?
I think if the writers strike a deal, the actors will soon follow. They seem to be in lockstep. Of course, they are different guilds at the end of the day. Sure. They are dealing with similar issues. So what the writers want is different from what the actors want. But I think if the writers can get this deal done, that'll set us up really well for the actors. And I don't think the SAG strike will last too much longer if the writers are able to get that deal.
It feels like if they don't come to an agreement now, then it kicks down to January. Why? I've been hearing some chatter about that. Why is that? If they don't come to an agreement, then there won't be talks again for a little while?
I don't think we can say that. I do think we will continue to have talks through the fall. But yeah, if we can't get this agreement now, especially with this proposed deal that at least Bloomberg is reporting, I do think it kicks the can further down the line. There's also been some discussion whether or not some studios would break from the AMPTP, like Netflix breaking or Disney breaking, so that they could continue to work.
You mean make stuff without union people?
Basically
or
make their own
agreement
deal outside of the studio. And I don't really foresee that happening, but that's been a conversation as well. And I think everything's on the table, especially the longer this goes on.
Very interesting. Thanks, Sally. Appreciate it. We got much more coming up. Stay tuned. You're watching Yahoo Finance. Shopping demands have shifted as consumers grapple with economic uncertainty. Tanger Outlets is capitalizing, growing its occupancy to over 97% in June as shoppers scour for deals and they look for more stores to buy them at. Stephen Yalof is Tanger Outlets CEO, and he's joining us now. It's good to see you again, especially after we got the retail sales number this morning that I'm sure you saw. They came in better than estimated. What are you guys seeing in your business that, maybe reflects that big number that we got overall?
Outlet centers are value shopping experiences for people that are looking to buy brands at the best possible price. And in this environment right now, that's what the customer is looking for. How do they get the brands that they want, named brands, international, national, designer, fashion, footwear, cosmetics? How do they get those products at the best price? Outlet centers are on sale every day, and the customer, they've discovered that, and they're coming back to shop there.
Even if on sale every day, are the discounts deeper right now to try and woo those customers?
Well, yeah, what we're seeing, particularly in our portfolio, is that the retailers that are discounting a little bit more are the ones that are seeing a lot more foot traffic into their stores.
And are you also seeing certain trends among types of stores? I mean, one of the things that stood out to me in that retail sales number was an increase in sales at apparel in particular, which hadn't been seeing a huge amount of demand.
Right. I think trends change. I think as people are going back to work, events, things like that over the last, I would say, 18 to 24 months, we've definitely seen apparel be a great recipient of a lot of foot traffic into stores. But still, the athletic fitness brands, I mean, they're running the show right now. And brands like Nike and Adidas and Puma, that's what the customer is really looking for. Also, the athleisure brands like Athleta and Lululemon are still holding their own, particularly in our portfolio, and are doing extremely well. On top of that, they're also big draws for the customer that's coming to shop with us. So when they know that they can get those brands at value, they stay for the other brands as well.
I think I even knew there were Athleta and Lululemon outlets.
Yeah.
I know.
New to the business.
Yeah.
And that's our job. We want to constantly flow newness into our portfolio. So we're out there looking at the next great lineup of customers. We want to bring in a younger consumer. That younger consumer is looking for the brands that they seek. So we're going after younger brands.
Those Lululemon outlets are like the We Made Too Much Mecca that I've come to be excited to go into. When we think of back to school shopping, this is kind of kicked off somewhere maybe mid to late July, goes all the way through August and even September in some cases too. What have we seen there in terms of some of the trends about how consumers are shopping? How's that showing up in your data?
Yeah, well, July was better than June. We just saw the sales numbers, and we're seeing that come through in our data as well. And I think it's a great opportunity for people who have a budget or people who are being hit by the economic headwinds that we're all seeing right now, gas prices rising, et cetera, that they can get to one of our shopping centers and actually get value product name brand value product for their entire family. Children's footwear, that's a program that's doing well. Brands like Gap, Old Navy, that are staples in our portfolio seem to be doing extremely well as well.
And then additionally here, we think about the way that consumers are spending too. And even if you are doing your back to school shopping, you might be putting out less cash and tapping the credit card or swiping to pay. I don't know what we're doing these days. If people are pulling out their Apple Pay, whatever the case is, where they're tapping into credit more so than just deploying cash on some of these purchases right now. Have you seen a significant shift there, even in this kind of back to school season?
Well, I think that credit is still king, and I think people are definitely using their credit cards. It's interesting, a lot of brands don't take cash anymore, particularly some of the quick serve food vendors or the grab and go food vendors, they're cash free. So a lot of people, I guess, are going back to either their Apple Pay, paying with their phone, or using credit cards regardless of what credit card they link it to facilitate their transactions, and that's everywhere.
I want to talk about location for you guys, geography, because I think of outlets as being a little bit farther out, right? They're not in the center of suburbs. There's been some reporting recently that the suburban strip malls are doing well right now because people are not commuting as much to the office. They can maybe run errands during the day, do some shopping. Are you guys still sort of pursuing that, not quite in the suburban centers, but out a little bit? What's your geographic strategy right now?
Well, look, the old narrative for the outlet center, and let's go back 25 or 30 years when they were first a thing, was to be as far away from the full-priced businesses as possible. And that sort of changed a little bit. A lot of those department stores that were the most sensitive to a lot of these direct-to-consumer brands, they were calling those shots. But now you see a lot of these department stores are actually in the outlets, like Saks Off Fifth or Bloomingdale's. So we'll see the department stores are actually selling their excess inventory in the outlets as well. We're actually under construction and we'll open in October a new shopping center in Nashville that's only 12 miles outside of the city. So it's relatively close. It's south of the city. It will have great access to the population and the tourism, but will also service that local trade as well. In other geographies that we have, the beach communities that typically saw far more shoppers come during the summer months when the beaches were more active, we're seeing people spending more time year-round in those areas. To your point, moving out to the suburbs, spending more time there, maybe fewer days in the office, more days working from home, and it's that day traffic that really gives us a big pop during the week.
We mentioned your high occupancy rate at the top, and I'm curious, are you guys keeping your lease rates steady? Are you offering companies promotions to get in there? What is that environment like now, say a year ago?
Yeah. Over the last 6 quarters, and we said this, our earnings call was a couple of weeks ago, and we said that over the last 6 quarters, our rent spreads have continued to grow, where we have positive rent spreads. And what does that mean? That means that the retailer, on a renewal basis, that means the tenant whose lease is up, who's renewing, is voting to stay in that shopping center, stay in that store, but pay us close to 10 to 12% more in rent for that space. And then in the case of a new, we call it re-tenanting, retailer leaves and somebody comes in and takes that space, paying us close to 25 or 30% more. So we're filling our shopping centers the way we're supposed to. We're finding retailers that can be more productive in space. When they are more productive, obviously willing to pay a little bit more for that productivity, and we keep on pushing our rents. That's why we've had the great NOI growth that we've been talking about now for almost 8 straight quarters.
Sorry, NOI?
Our net operating income growth.
Thank you, just to make sure.
Yes, sorry.
The same way that we say Target is Target sometimes. Tanger has really become kind of a Tanget, if you will, with the luxury brands that have made their way into your experiences. When you see tie-ups like we did between Tapestry and Capri Holdings even, what goes through your mind? Does that mean you could have a propensity of some more of those brands that might not have already been in these shopping experiences making their way to Tanger outlets type experience?
So our customer, and we talk about this frequently, our customer is an aspirational customer. And what that means is they're looking for brands, and they're looking to buy into these brands that they may never had an opportunity to buy into before. Madison Avenue, some folks just might be turned off by the price point on Madison Avenue and never walk into one of the luxury stores that show up there. But in an outlet center, I think people feel a little bit more that the stores are all a little bit more approachable. So the approachability of those stores will get a new customer who may never interacted with a particular brand before to come in. And when they come in, it's up to that sales staff to provide to them an entry-level price point that they can afford, allow them to buy into a particular brand, and now that brand owns that customer. So, we see part of the outlet narrative not only providing great value to the shopper, but giving the retailer great access to a whole new customer that they never saw before, that they can trade up through their ecosystem and make them the customer of the future.
Just quickly, has there been a massive shift or at least a noteworthy one among aspirational customers in the age of increased services spending right now into experiences?
Well, I'm glad you brought that up, because I think that the whole outlet experience is evolving. We talk frequently about the fact that we're seeing the customer shop completely differently post-COVID than they did before. The outlet shopping, we were talking about the centers that were a little bit further away, that people had to make sort of a dedicated trip to get there. Now what we're finding, since the outlet centers are a little bit closer in, or the people have moved closer to where the outlet centers are, it's up to us, in order to get that multiple visit, get that customer to come back more frequently, to provide them with more things, better amenities, better food and beverage, which we've leaned extremely heavily into, and it's paying back. You know, the great sit-down restaurants sort of avoided the outlets 20 or so years ago because they saw that as a weekend shopping visit. But now that we're seeing a customer during the week, these restaurants are taking notice, and we're capturing a lot of that business.
Stephen, we could keep this conversation going all day. We got to leave things there, though, for right now. Tanger Outlet CEO Stephen Yolof, thanks so much for taking the time.
Thanks for the time.
Absolutely.
Appreciate it. Well, Rochelle Akufo has you for the next hour of trading. Keep it right here.
Fun.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. Home Depot earnings kick off a hot week for retail with a dip in same-store sales. We'll break down those results coming up this hour. And a new indictment for the former king of crypto. We've got the details on Sam Bankman-Fried's latest charges. Plus, shares of On Running are trending downhill this morning. That's after net sales projections fell short of expectations. I'll speak with the co-CEOs on the back of those results. But first, let's take a look at how markets are faring an hour and a half into the trading day. We're seeing some red across the board here. The Dow here now off more than 300 points. The S&P 500 also down about 39 points or 0.8%. Tech-heavy Nasdaq also down about 115 points. A lot of disappointing China data out, as well as hotter than expected retail sales data for investors to digest. Let's also see how that's playing out on the treasury markets as well today. We're seeing a mixed picture here for the shortest term yields there. Those are down about 0.92%. The 10-year still above that key 4% mark though, but just down ever so slightly, about 0.25% today. And the longer term 30-year yields, that's up just barely though, as we can see. Well, Home Depot saw pressure in big-ticket discretionary spending weigh on same-store sales in its second quarter. The cautious consumer also causing the home improvement retailer to reaffirm its guidance that it set last quarter, expecting a drop in sales and adjusted earnings for the full year. Joining us now is Bill Darcy, National Kitchen and Bath Association CEO. Thank you for joining me this morning here. So, looking at this pullback that we're seeing, comparable sales falling, especially these big ticket items, these costing $1,000 or more, dropping about 5.5% in the second quarter. What is that telling us about how consumers are feeling about these big ticket items, having really been stuck in these homes for the last 3 years?
Yeah, great to be with you this morning. NKBA partners with John Burns to bring the Kitchen and Bath Market Index to our industry every quarter. And we've seen that growth has slowed in alignment with what Home Depot was talking about this morning, about 3% year over year decline in sales. And foot traffic has been down in the showrooms and about 8% since the prior quarter. So the retailers have been struggling with that foot traffic.
And what do you chalk that up to? Is it that a lot of people already made all the improvements they were going to make during the pandemic and they really don't want to then take on a new mortgage and perhaps, spend even more in a new home?
It's really that, it's the price pressures that we're all dealing with as consumers. They're uber sensitive to pricing, and especially at the lower and mid price tiers, not as much on the higher end. A lot of online price shopping, but they did do a lot of projects during the pandemic, and our industry was very healthy through the pandemic. And because these continual price pressures, the consumers can only take so much. I think the long game, though, for what we're seeing is a very strong health for remodeling. So despite them dealing with the short-term pressures of pricing, there's a lot of manufacturers making big investments, and I think we see a lot of long-term health in the remodeling sector.
And talk about some of the key findings in that KBMI index. I mean, right now it's rated 56 out of 100. That's down from 62 in the first quarter of 23. But we are seeing, as you mentioned, the kitchen and bath area specifically also going at a slower rate in the second quarter. What is it about perhaps some of these big ticket items and the spending? What are some of the consumer patterns you're seeing there?
Yeah, the consumer still, I think, most people want to invest in the home. The pandemic just accelerated that investment and focus on the home. But it is tough because especially at the lower and mid tiers, the consumers are, they're dealing with high gas prices and inflation. But those high interest rates don't harm the remodeling sector as much because there's a lot of equity in the homes, as we talked about, the lower interest rates that people are in. So they really, instead of moving, are continuing to be interested in investing in the home. However, at the moment, they're just dealing with these cost pressures, so it's causing them to pause a bit during this this period. But we do see a big rebound coming in 2024, again, primarily because you have 22 million homes in prime remodeling years, and there's a lot of repair, replacement, and remodel that's required in the North American housing stock. So, but in the current period, they're dealing with these price pressures that all consumers are right now. So that's impacted our retailers significantly, as you saw in the Home Depot's earnings as well.
And of course, if we are expecting that boom in 2024, you're going to need labor in order to build a lot of these projects. What are you seeing in the labor market here in terms of, access to workers to really keep up with some of these projects that you're expecting?
Yeah, that is a big struggle, and it's been only exceeded by those pointed pressures that have come with the recession fears and other things. But right now, we are back to the labor shortage is the number one fear in our industry, and it's an ongoing long-term problem. As you likely know, the young people entering the market is not strong, and retailers like Home Depot are dealing with it in the contractor market, and we're dealing with it. Home Depot is our member, as well as the smaller retailers, really struggling to find young people. We try to do all we can, and I'm on the operating committee of a skilled labor fund that continues to drive interest for young people and construction careers. But it's very difficult as the young folks are not as focused on these careers as they were in the past. So we have to continue to work very hard to help support the industry and spread the message about the positive as far as being part of this industry. It's very tough right now, and the labor shortage is hurting us.
And is there anything that can be done in terms of innovation? I mean, we talk about, AI and sort of, smart building and things like that. What sort of investments do you think the industry should be making while they do wait for some of these labor and these skills to catch up?
Yeah, it's interesting on the AI and really in technology in general, because to me, that's the appeal for the young folks is there's so much tech involved in our industry and the investments in different types of home construction. Certainly in the kitchen and the bath, you have this IoT environment and connected devices and the devices talking with us and telling us when they need service. And, so to me, there is a big appeal. And my call out to young people and the parents is, look at the technology in our industry, and if your young folks want to be involved in technology, the home construction, the home industry, and repair and remodel is a place to be. There's a lot of tech involved, so there is a lot of investment, and I think the consumer is really looking at areas where how can it help me immediately? When it can tell me there's a leak, can it tell me my appliance needs service? But in addition to that, I think we're all just so accustomed to everything talking to us and giving us notifications. I think there's a continued investment our industry is making in high performance, high technology cooking and in the bathroom and sanctuary spaces.
And as we talk about technology in this industry, what about the way that people are currently shopping for some of these items for their small projects or big ticket items? It used to be everyone sort of flood to the big box stores, but there are a lot of other options now. What are some of the changes that you're seeing?
Yeah, it's interesting. We are still a high-touch industry, but there's a lot of shopping and price comparisons being done online, and it's accelerated right now due to the cost pressures. So it's a matter of for us, meeting in between where know that consumers are shopping online, know that they're doing a lot of price comparisons, but they really still want to go into the showrooms and retailers and see the products. There's so much that we interact with in our kitchens and our baths that it's hard to make a decision online for the full product. There's so many dynamics that go into it and what you want to, have your kitchen achieve in cooking and ventilation and lighting and countertop services. There's just a lot in our industry, and so it's a high touch environment, but there's so much that can be done. And the consumers are certainly pursuing that through online and their ability to experience a product, or up to the certain point. They would like to be much more prepared when they enter the showroom than, as you say, in the old days when they just wandered in and got to experience it for the first time, potentially in a physical environment.
And certainly when you make enough mistakes buying things online for your home and you realize they don't fit, it's not the right size, that definitely does make you want to come back into a store and actually
it's
have
a complicated
some professional
purchase.
Help in person.
I think the NKBA
indeed.
members can help people a lot, and I think that's really where it is. It's a complicated buy, and you don't want to have something that you invested a lot of money in that made a big mess, and it's beautiful now, but you want it to be right, and I think partnering with a professional is what we advocate for.
Indeed, I certainly second that. A big thank you there to Bill Darcy, National Kitchen and Bath Association CEO. Thank you for your time this morning.
Thank you for your opportunity. Appreciate it.
Well, Chinese officials are reportedly considering cutting the stamp duty on stock trades in order to boost the world's second largest equity market. Joining us now to break down what this means is Yahoo Finance reporter Ines Ferre. Hey, Ines.
Hey, Rochelle. Yeah, and this measure would really be a boost for Chinese equities if they were to cut that stamp duty. A stamp duty is like a levy on stock trades, and this would be the first time that it's cut since 2008. Now, the stamp duty currently sits at 0.1% on stock trades, and a draft proposal is being considered. The Chinese equity market is valued at $9.9 trillion, so it's very sensitive when it comes to any type of shift in liquidity. And the stock market really is a barometer of consumer and business confidence. So the government is trying to boost investor confidence, trying to keep capital flowing into the markets. The Chinese economy and households are going through some major challenges right now. One is falling property taxes. The other is a weak job market. And you had Chinese equities that had a 2-month rally, which then fizzled out. You had global funds that were selling into that rally, believing that perhaps that whatever the Chinese government was doing in terms of stimulus to shore up the economy wouldn't be enough. Now, China's stamp duty is on stock trading has been adjusted several times. It was adjusted, as I mentioned, back in 2008. It was cut to support a market plunge. And in 2007, as you saw a market melt up, as the market was rallying, you had investors, China had more than 300,000 new investors entering the market. So they, at that point, raised the levy in order to sort of cool down that rally.
And another aspect that we're watching, China's seeing a lot of slowdown in employment, especially youth unemployment. So tell us about that latest data, or the lack thereof.
Yeah, and the youth unemployment number has really gotten a lot of attention over the last couple of months. You'll recall that back in July, when the GDP print was put out for the second quarter for China, that another headline that came out was the youth unemployment that had skyrocketed at a record high, 21.3%. That's 1 out of every 5 young people in China that were without work in June. And now the government is saying that they are going to pause giving out the youth unemployment number on a monthly basis. Young people, by the way, is defined by 16-year-olds to 24-year-olds. And the Chinese government is saying that labor statistics need to be optimized, more research needs to be done. They're also considering whether or not to include young people who are in college who have not graduated yet and are looking for jobs, whether they should be counted or not. Remember also that in China, many young people do internships. They do internships while they're in college, just like here in the U.S. as well. So whether or not some of those figures should be included. But look, there's been a lot of negative attention placed on this new idea or mandate that they will not be giving out these numbers on a monthly basis, because many are wondering, well, how bad is it? We just had a record high of youth unemployment of 21.3%. Is the government hiding something? Transparency issues that are coming to light. And it is a gauge for how well an economy is doing as far as unemployment figures are concerned. So there's been a lot of buzz around that, but a lot of concern as well that, look, if you have a lot of people, young people who are without jobs, that is a risk to a society as well.
Especially one that has a very high aging demographic as well. You have to wonder what that pipeline means then for the economy. Thank you for that breakdown. Our very own Inez Ferreira.
Thank you.
Right, well, I'm watching shares of Lyft, the stock jumping today on news that new CEO David Risher just bought a bunch of stock. That's according to an SEC filing. The executive purchased 100,000 shares at $11.46 per share on Friday. Could be a positive sign of what's to come for the ride-share company. I'm also keeping an eye on Hawaiian Electric. Now, the stock extending losses on concerns that its power lines may be linked to the deadly wildfires in Maui. Now, the news comes as the death toll from the fires rises to 96, a number that is expected to increase over the coming days. A class action lawsuit was filed over the weekend, alleging that the utility company's energized power lines were knocked down by strong winds, causing the devastating wildfires. The suit also alleges that Hawaiian Electric Industries, quote, chose not to de-energize their power lines during the high wind watch and red flag warning conditions for Maui before the Lahaina fire started. Despite knowing the risks and that the company and subsidiaries, quote, also chose not to de-energize their power lines after they knew some pole lines had fallen and were in contact with the vegetation or the ground. Now, it's not yet been determined what started the wildfire, but we'll certainly keep you posted. Right, all your markets action still ahead. Stay tuned. You're watching Yahoo Finance.
Will this most anticipated recession ever actually come?
I think so. I think it's too premature to completely discount the recessionary fears. I think we're still seeing tightening in lending conditions. We're still seeing a lot of that percolating through the economy. I think we will have a recession, but it will be a mild one.
Back in November, crypto markets were shaken by a major scandal when FTX CEO Sam Bankman-Fried was accused of fraud, of wire fraud, securities fraud, and money laundering. On Monday, federal prosecutors filed a new indictment against the former face of crypto, saying he stole from customers to contribute to political campaigns. Let's bring in Yahoo Finance's Alexis Keenan to give us some more insight. This just seems to keep going on and on, Alexis.
Indeed, it does. And Rochelle, this also comes on the heels of Bankman-Fried being sent to a Brooklyn detention center after a judge on Friday revoked his bail. But let's take a look at this new charging document and what it is. It's a superseding indictment. So it's just building upon, amending that previous indictment that was faced by Bankman-Fried. In it, the prosecutors are reincorporating some campaign finance allegations against the former FTX CEO. And those were previously dropped when Bahamas officials said that they never originally intended to extradite him from the Bahamas on that particular charge. So what it says is that through two different what are called straw donors, that Bankman-Fried directed executives at the company to use them to hide that the source really for these political donations was coming from FTX's hedge fund Alameda Research. The way that the prosecutors describe it is this. They say to conceal the fact that the Alameda account containing FTX customer deposits was a source of the donations, Bankman-Fried directed that money from the Alameda account be wired to these executives' personal bank accounts, and that these executives then make donations in their own names. Now, one of those executives is named in this new document. He is FTX's former head engineer, Nishad Singh. He has already pled guilty to fraud and campaign charges. He had donated $9.7 million to Democratic causes. The other alleged straw donor is not named in this document. And of course, Bankman-Fried is still facing those original charges. There are 7 of them, from wire fraud, conspiracy to commit wire fraud, also conspiracy to commit securities fraud against FTX's investors, fraud against its customers, as well as commodities fraud conspiracy on FTX customers. So he still has those original charges. The documents don't change that much, but certainly here you see prosecutors wanting to highlight that they do believe that these donations were made in an invalid and illegal way. Rochelle?
I mean, quite the fall from grace there for being really essentially the face of crypto and really helping with crypto regulation to now what we're seeing here. I do appreciate that update, our very own Alexis Keenan. Well, back in February, PayPal CEO Dan Schulman announced that he would be retiring at the end of the year. On Monday, the company announced that Alex Chriss, the executive vice president of small business and self-employed group at Intuit, would be taking over the position come September. Let's bring in Yahoo Finance's Ali Garfinkel to discuss more. Hey, Ali.
Hi, Rochelle. So quite simply, Chris is walking into a minefield here, and there are going to be 3 key things he needs to contend with immediately day one as PayPal CEO. And the first and probably the most important is growth. Now, I'm not just talking about revenue growth here. I'm talking about margins. Margins have been a key issue for PayPal for some time right now. And last year, they were the center of the company's activist battle with Elliott. And it persisted in being a problem to this day. We only need to look back at Q2 to see that. Here's a staggering statistic for you, Rochelle. 11% of total payment volume growth and 7% total revenue growth in Q2 for PayPal, but that spurred a mere 1% gross profit growth. So this is something that there is going to be a lot of pressure on Chris to deal with immediately. Now, the second thing is going to be competition. PayPal has had this incumbent advantage for a long time, and that incumbent advantage is slowly disappearing. A recent Deutsche Bank survey is sort of the place to look for this. Square owns Cash App, right? And there's, of course, Apple Pay, and both have really been gaining ground, gaining adoption. For instance, in the past year, respectively, Cash App and PayPal reached 46% and 31% adoption. Those are spikes of high single, low double digit since the year prior. The last thing to consider, of course, here then is the shoes, of course, that Chris will be filling. Dan Schulman, the CEO of PayPal, has been the CEO of PayPal since 2014 when it went public as spinning off as its own company from eBay. And Schulman kind of isn't just any CEO. He really is a legend in his own right. And Chris is going to be filling his shoes at a moment when the company's stock hasn't done well, even amid a broader tech rally. To that end, Rochelle, PayPal stock at the moment I sat down in this chair is down 17% year to date.
So then digging into this then, just how important has Schulman been to the financial services landscape during his tenure?
I think it's a really good question, Rochelle, because in a lot of ways, Schulman really is the first of his kind. He's someone who's existed for a long time at the intersection of these entrenched industries and tech, right? Schulman, even before PayPal, he was someone who was really notable, right? He was the founding CEO of Virgin Mobile. He was this early formative CEO of Priceline. This is almost, in the case of Schulman, like a tech founder stepping aside. That's how associated he has become with PayPal. And this isn't just a succession to, it really is signaling a new era. And Schulman himself has also, I think it's not an exaggeration to say Schulman's been a cultural figure in a lot of ways. I was talking to our executive editor, Brian Sazzi, about this today, and we both were like, man, have we ever seen him without his cowboy boots on? He also became one of the first CEOs to practice martial arts in a really public way. I believe he practices Krav Maga. So it's the sort of thing where Schulman himself has come to represent a lot. And I don't think it's an exaggeration even to say that he's someone who has helped reshape how we think about American capitalism, payments, and tech.
I mean, you mentioned Krav Maga. Well, I can think about that face-off between Musk and Zuckerberg here. Maybe a new contender enters the ring here as he takes the helm here at PayPal. Great always to get your updates, our very own Ali Garfinkel. All right, all your markets action still ahead. Stay tuned. You're watching Yahoo Finance.
What has been the stock story of 2023?
I would have to say it's AI. I know everyone's saying that, but I would say artificial intelligence dominated Q1 earnings. Certainly when you see the returns, it's been concentrated in a few really mega cap names. But the interesting part of this is, on one hand, it's about artificial intelligence, but then it's also about the fact that these are companies with massive free cash flow generation. So part of it is the story about technology, innovation, AI, but then the other part is, what's the major theme? If you have positive free cash flow generation, you have that money to fund innovation, you have that money to fund further growth, and that's what the market's going to continue to pay attention to.
Shares of On Running are heading downhill this morning after its net sales expectations fell short of estimates. The athletic brand did, however, raise its full-year outlook and saw gross profit rise 64% year over year. Martin Hoffman, On Holding Co-CEO and CFO, and Mark Mara, On Holding Co-CEO, join me now alongside Yahoo Finance's Brooke De Palma to break all of this down. A big welcome back to all of you here. So a tough morning as we're looking at the stock this morning. Breakdown, we'll start with you, Martin. What you think is happening in terms of perhaps the story that investors are missing or what they're honing in on?
I think first and foremost for the company, for the team, it's been an amazing quarter. It was the 6th consecutive record quarter that we had. 50% growth, 60% on a currency neutral base. All regions, all channels are growing strongly. Our best gross profit margin since the IPO is 59.5%, more than doubled our adjusted EBITDA compared to last year. Clearly everything above our expectations. We increased our guidance for the rest of the year. We see continued strong demand going into the third quarter. So we are super positive and we are clearly on track towards our long-term mission of building a company that is set up for durable growth on top line and profitability.
And Mark, I mean, we did see people really digging in on these earnings, especially focusing on the impact of the strong Swiss franc. What are your expectations there, and how long do you expect that to keep really weighing on the earnings picture for you?
I mean, we're focusing on influencing what we can, which is the products that we're creating and the stories that we're telling and how we're reaching the consumers. I think we're very clearly planning with different currency situation for the months to come. It has a stronger top line impact that it has a margin and bottom line impact because there's a lot of natural hedging happening there. But I think in the end we're trying to be open with our communication in terms of what we see on the currency situation, and we're focusing on our implied growth and how many products we bring to the market. Again, and to Martin's point, we're extremely happy with where we stand and also how Q3 has started.
Martin, I want to hone in on that consumer a bit. We did see net sales increase 52%, driven by a high-end consumer. Do you think that this wealthier consumer is able to shrug off inflation here?
Yes, we're speaking about end consumer. So it's really the end consumer that is driving the sales. So both our retail partners are seeing very strong sellout numbers. We are seeing very strong sales in our direct channels, be it our e-com channel, but on also our growing own retail network. And of course, there was some cautiousness how the consumer would react in the current macro environment. We clearly see a bit of a stronger impact of that environment in Europe compared to the US. But as Mark just said, the brand is strong. We have an exciting pipeline of new products coming. We just launched, for example, the Cloudboom Echo 3, our fastest product yet. And this gives us the confidence that is reflected in the numbers.
And I do want to talk about where consumers are getting your products. Direct to consumer, still a majority of your business, but you are, dipping into retail partners. We see a heavy partnership with Foot Locker. Where do you see these points of access really increasing awareness for On Running and driving sales?
Yeah, for us, it's always been important to reach the right consumers through the respective retail partners, right? So Dick's is reaching a different consumer than, for example, JD or Foot Locker is reaching, or Fleet Feet as Run Specialty is reaching. And we're really seeing across geography. So whether it's Europe, whether it's Asia Pacific, whether it's the US, very strong growth rates in wholesale and in D2C. And it's in all wholesale channels. So we don't have a channel that is not growing or growing much, much slower. So it's very consistent. And this also then shows that we're tapping in new, younger consumer segments with, for example, Foot Locker and JD, and that strategy is working out. But at the same time, we're the fastest growing brand at Fleet Feet, and we can significantly expand our market share in the running category. And this comes in an overall environment where we have a lot of price pressure from other brands. There's a lot of discounting happening in the market because of overstock situations at some retailers with products from other brands. And we're very happy that we continue to perform super strongly against that, and we can drive full price premium sales. This shows in the highest gross profit margin ever. And we already mentioned it, D2C share continues to grow, which is important because it's our direct access to the end consumers, where we can bring our full product range to life.
And Martin, as we talk about the product range, you mentioned the Cloud Boom Echo 3. Talk about what the success of that model has done for you and what it means for sort of future innovation and the demographics that you're targeting.
Yeah, if you look at running, you basically have runners like myself who are everyday runners, but then you have a lot of athletes who are really going for the best possible time. And the Cloud Boom Echo 3 is constructed and built for those fast runners, especially on the mid to long distance. It has been developed together with our amazing athletes who are now also ready to go to Budapest and compete on the biggest stages there. It provides a lot of new innovations, a super strong helium foam, carbon plate in there. And we expect that this is elevating our presence and market share on the marathons of the world. And then it's trickling down into the everyday consumer, where we have already very strong franchises like the Cloud Monster, like the recently Cloud Surfer, and to grow our market share there. And I think that's the reason why we are currently the fastest growing brand in run specialty as well.
I want to talk about that trickle-down effect. I couldn't help but notice this morning on my commute to Manhattan, I saw someone wearing your shoes on the way to work. When you think about, the different range that you're now getting in terms of ages and, how they're wearing your shoes, even for the everyday wear, what does this mean for future growth plans for the business? Are we going to see a broader audience in years to come?
Yeah, I think it shows that On is a premium sportswear brand that is rooted in performance and rooted in innovation. And this really allows us to have product like the Cloud Boom Echo, very much rooted in running and the performance core of it, but then it's being adopted by people that are wearing it all day and every day. And you can also even actually run to work with the product, or you walk to work with the product. And so for some people, performance means fast times and a carbon plate or whatever. For other people it means comfort, and I think this is how we're bringing some of these elements into many different products, also on the apparel side. So we're seeing very strong growth in our apparel range. We're seeing apparel growing especially strong around in our own stores, and that shows the potential that the brand has that goes way beyond the core running segment and is much broader than that.
And certainly you have tennis legend Roger Federer as agreeing to become one of your global ambassadors there. So for the non-runner who is looking at your brand and trying to see the appeal here, what would you tell them?
It's an innovation brand with a great design language. Also, if you focus on sustainability, we have fully recyclable and circular products in our range. But all of them, as Mark just mentioned, they give you access to the outsole technology that allows the best runners to perform, but it also allows you to enjoy every day on your feet.
And I do quickly, want to ask, I couldn't help but notice on your site that there's an opportunity to buy last season's items, whether it's apparel, footwear, even socks, ranging from 20% to 50%. But the catch, you need to be an account member. How does this help get rid of inventory, drive sales, and boost loyalty here?
The first thing is great you notice, because it shows that we're gaining and attracting more consumers, that more visitors are kind of seeing our website on.com every single year. We already have the same logic for many years actually. So, but because On is getting bigger, more people notice. And it's a very normal thing, we have product life cycles. We have products that go out of line as we're updating apparel, as we're updating footwear. And this summer, we ran the Classics campaign, where basically you have product that goes out of line, accessible at lower rates. And we're trying to bring that to our most loyal customers, also being able to bring the value proposition from on to you when you not shop. And this is why that you're part of the environment is very important for us and beneficial for you as a consumer.
We'll certainly see a lot of brand loyalty for your company. A big thank you for joining us this morning. Martin Hoffman, On Holding Co-CEO and CFO, and Mark Maurer, On Holding Co-CEO, joining me alongside our very own Brooke De Palma. Thank you so much.
Thank you so much for having us.
You're very welcome. All right, it's time now for our chart of the day, and we're focusing on cruises. Now, the battered sector is seeing a bounce back as it claws back from the demand hit it took during the COVID-19 pandemic, with forward bookings now hitting an all-time high. That's according to a new report from Melius Research. Norwegian Cruise, Royal Caribbean, and Carnival have all seen strong gains so far this year as the sector trends towards recovery. All right, stay with us. All your markets action still ahead. Stay tuned. You're watching Yahoo Finance.
This earnings season, has it lived up to expectations?
I think it's been fine, but I think it's been a little bit soft. So I think the problem is we got used to all these positive surprises and coming out feeling really good, and we just haven't had that.
Wendy's is revamping its kitchens, making it the latest hamburger chain to start redesigning its restaurants. Now, many chains have taken to modifying their in-store experiences with the intention of maximizing digital sales and making the to-go experience much easier. Let's bring Yahoo Finance's Brooke De Palma back in to give us those details. Hey, Brooke.
Good morning, Rochelle. That's right. Wendy's telling Yahoo Finance exclusively the launch of its next-gen kitchen design. Now, this is ultimately in a attempt to increase kitchen capacity as well as fuel growth here, particularly when it comes to digital sales, which is a major business for Wendy's. So the next-gen kitchen design is for restaurants with the highest customer demand. It's intended to deliver a nearly 50% increase in kitchen capacity compared to that of its next-gen design, something that they announced in late 2022. It includes a dual-side layout that includes its intention to include an increased speed of service as well as volume of service. Now, on top of that, that next-gen design that the company introduced last fall in late 2022 is now open in both Kansas and Oklahoma. Abigail Pringle, Wendy's Chief Development Officer, telling us that they know that digital is a part of the future, and they've seen a growth pre-pandemic, but that really pushed way through the pandemic when it comes to digital and mobile orders. And in addition to that, they have to then, change the way their restaurants look to then meet that digital need of fuel, a growth driver really for Wendy's as well as other fast food companies. In addition to that, they do plan to have elements of this next-gen restaurant design to be included in more than 200 stores, or rather, this included in more than 7,000 of their stores, and they plan to open a next-gen restaurant design, so this very future-focused format in more than 200 stores throughout 2024. And so your local Wendy's may be looking a little different in the coming year.
And as we seem to just want our fast food even faster, Wendy's not the only company doubling down on technology and restaurant renovations to drive sales. What else are you seeing?
Yeah, well, really, they're doubling down on the way that consumers are behaving, particularly here in the U.S. We're seeing really consumers change the way that they interact. As you can see right here, consumers are taking more meals on the go. Pre-COVID, they saw about 70% of consumers, taking meals on the go, some opting to dine in, but now 85 to 90% are taking meals on the go. And so what we're seeing here is these fast food giants really adapt to that change. Last summer, we saw KFC introduce their next-gen design that included mobile order pickup, consumer pickup in store. We also saw a mobile order pickup outside for companies to really double down on that third-party delivery when it comes to Uber Eats, as well as Grubhub, among others. We also saw Chipotle introducing a new kitchen design in an attempt to help with labor time so that ultimately employees can come in at a later time and cook their chicken and steak faster. We saw those cook times drop dramatically when it comes to this updated kitchen design. That ultimately in an effort to get customers in and out and ultimately fill those mobile orders faster. In addition to that, we saw McDonald's introduce in Fort Worth, Texas, a completely digital on the go. It has essentially no seating, attempted to, win over those consumers who are on the go. And in addition to that, we're really just seeing a slew of other names, Dutch Bros, Potbelly, as well as really, once again, Chipotle, Yum Brands, and McDonald's doubling down on this digital-first approach to really boost and meet those increase in mobile orders here.
Certainly one of those post-COVID things that's just here to stay. We got comfortable not spending so much time in these restaurants, and now this is the result. Fantastic stuff. A big thank you there to our very own Brooke De Palma. Well, the name David Solomon is perhaps most synonymous with Goldman Sachs. Now, if you're not the avid follower of his DJing career as DJ D-Sol, last week the New Yorker ran a somewhat critical article of his tenure so far. Our next guest has written an opposing piece for the Financial Times, arguing that one should not get bogged down by criticism and instead look at the hard data from the bank, which has seen changes and growth under Solomon's leadership. Let's bring in fintech and bank strategic advisor Rupat Ghosh. Thank you so much for joining me this morning. So, we did see New York Magazine. They didn't cut any, they weren't very soft in that op-ed title. Is David Solomon too big a jerk to run Goldman Sachs? But you're basically saying perhaps they should be focusing on other aspects of the actual business themselves. Break down your base case from your op-ed.
Sure. I think, look, in essence, I think, you can't be a jerk and have bad performance, bad risk management, and bad compliance as CEO of an investment bank. But if you do have good performance, particularly very good performance, I think you can afford to be a jerk of somewhat nature. You can't have compliance breaches, you can't have risk management breaches, but none of the articles that have swirled around the media in the last 12, 18 months have talked about risk management and compliance breaches. And actually, the operational performance of Goldman Sachs has been very good under David Solomon. If you look at the 5 years he's been CEO, the share price is up almost 50%. It's up, that compares with the average bank stock that's down 20%. It's lagged Morgan Stanley. That's the Achilles heel that James Gorman is doing so well. But he's actually outperformed Jamie Dimon. How many CEOs can say they've had a share price that's outperformed Jamie Dimon? And he's outperformed pretty much every major bank CEO in Europe and the US in terms of share price. Why is that? They've had book value growth of 55 to 60% in over 5 years. What is book value? It's essentially the profits that they generated over 5 years. The profits have been very, very strong. Returns have been very strong for the last 5 years. And market share has been very strong in its core business. Market share is really important because the market can go up or down. A lot of retail banks are doing very well in the US because obviously rates have risen. There's a flight to deposits out of Silicon Valley into JP Morgan, into Bank of America, and so forth. But market share, Goldman has been at record levels in its fixed income business, bond trading, commodities, so forth, in equities, where they're very strong with hedge fund client base. So they are doing very well in their core businesses. Last couple of quarters have been a little bit messy, but that's partly because of the consumer business, where we've obviously had some high-profile issues with performance. They went into consumer. That was actually Lloyd's idea rather than David's idea. And they're unwinding that, and they're coming back closer to home, where they're focusing much more on asset management as a strategic focus. I think if Solomon gets three things right, firstly, gets quarterly earnings motoring again, which is key, I think. Consistently, he was generating mid-teens, double-digit returns on equity the last couple of years. The last couple of quarters have been mixed because of these write-downs in private equity investments, because of the consumer banking unwind and so forth. But if he continues to get the market share in its core businesses and mid-teens returns, I think shareholders will like that. I think the old saying that success is 1,000 fathers and failure as an orphan, I think it applies here. And that consistency with quarterly earnings is important. I think secondly, unforced errors, whether it's going up to Hamilton College and getting misunderstood or speaking out of turn, or other things he's done internally and so forth. Again, no compliance breaches and no risk management breaches so far, but generally no unforced errors is, I think, the second thing that's really important. And I think the third thing is a strategic vision. I think the move into consumer was incorrect. Goldman, as sort of barbarians of the gate, thought they could go anywhere, and consumer was an area they failed in. But sticking closer to home with asset management, where they have a core DNA in alternatives and hedge funds and private equity, I think is a focus, and really growing that business so they can expand their multiple. The way that we analyze bank stocks is a price to book value, and the price to book value of Morgan Stanley has risen significantly as James Gorman has moved that business out of more volatile investment banking into more recurring wealth management. And Solomon has to achieve that over a number of years.
And so then at the end of the day, I mean, does it even matter then when you compare, your Gorman, your Dimon and Solomon together and their leadership styles, if when you actually look at the financial performance, Goldman is still in a very good place? And also, what would the succession plan even look like? Is there even a clear line of succession for David Solomon?
Yeah, I think the performance of the business has been strong under him. They haven't had that strategic expansion they needed to do. But he's had some headwinds in terms of the investment banking business and so forth. And I think if you take Gorman out of the equation, I think he's probably done as well as anyone in the last couple of years. And many of the Gorman decisions were done over a decade. And I think your point about succession is very important. And also, I think we look at CEOs that of past and people of the past often through rose-tinted eyes in terms of if you look at the history of his predecessor as CEO. They lost a lot of market share in fixed income post the financial crisis, whereas the Dodd-Frank rules bit. They had some massive scandals with Malaysia in terms of the sovereign wealth fund there and some massive fines. So they've had some issues in the past. Previous Goldman CEOs have had issues, whether it's John Corzine with MF Global or Bob Rubin at Citigroup and so forth. So there isn't an obvious bench here of people. And I think you're showing a chart of partners leaving. The fact is that Goldman partners are phenomenally well paid. That's why they have very strong views and so forth. And they are very well connected, and people want to hire them on the street. But I don't think the turnover at Goldman at senior levels has been materially higher than under previous regimes. I think it's a sort of clickbait that obviously at the moment it's great to highlight those those departures. And look, it's not normal to have that many partners speaking out to New York Magazine in that much detail. But I do think there is an issue with succession here. Who would be the obvious successor? Everyone talks about Waldron, but he's close to Solomon. There isn't an obvious successor. That people talk about Blankfein coming back, but again, I would question his legacy, whether it's 1MDB in Malaysia, whether it's the FIC market share losses that he had, the strategic vision that he had. There was really limited strategic change under his reign.
And it certainly does seem that, people, at least investors, aren't as worried about how the sausage is being made, and they are focusing on that financial data. A big thank you there to FinTech and Bank Strategic Advisor Rufat Ghosh. Really fascinating conversation there. Thank you for your time this morning.
Thank you so much.
All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance. Let's do a final check of the markets. As we can see, still in negative territory, though, off the session lows. The Dow, they're down about 270 points now. The S&P and the Nasdaq still under pressure as well. That's it for now. I'm Rochelle Akufo. I'll see you tomorrow, 11 a.m. Eastern.